Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stocks extending their jobs day declines here after a blowout report reshaped investor expectations for Fed rate cuts in 2025. Bond yields continued to climb following the data release and ahead of a key inflation print later this week. Investors are going to be closely watching December's CPI numbers for any signs on the Fed's inflation battle.
Plus, earnings season shifting into full swing. Results are due out from JP Morgan, Goldman Sachs, Morgan Stanley, Wells Fargo, Bank of America, and Citigroup in the coming days. Investors will be looking for record fourth quarter trading revenue following the election, as well as commentary on the 2025 outlooks and implications of a second Trump presidency.
And Apple is facing a sales slowdown. According to new data from Counterpoint Research, Apple sold 5% fewer iPhones globally and lost ground to Chinese rivals last quarter. The pullback comes as Apple has been slow to release its Apple Intelligence software outside of the U.S., with no AI features available in any form in China. Last quarter, analysts also began warning that some investors harbored overly optimistic expectations of AI features. Apple marked a 2% sales decline for the full year, according to the research, at a time that the wider market grew 4% globally. A big week ahead for investors, ranging from bank earnings to the latest inflation report. Joining us now to break it all down in this week ahead, we've got Yahoo Finance's own Josh Schaefer here. You're pumped up for this week. We're pumped up. We're excited.
It's going to be a busy week.
Busy week ahead.
Busy week. Always is, though, right?
What are you most excited about, though?
I'm probably most excited about that inflation print on Wednesday because I think that's what the market is most excited or most interested in this week, right? So we have the CPI report on Wednesday. We actually have the producer price index coming out tomorrow. Also probably going to be a market-moving event considering how we've been moving on some of these macro data points recently, guys. And the key question here, of course, being, can we get anything that will bring down the 10-year yield out of this economic data? In this case, for inflation, it would probably be lower than expected inflation, right? Right now, what we're expecting out of this core CPI report consensus, expecting inflation to stay at 3.3% for the fifth straight month. So if you look at the core CPI chart, it's kind of been the epitome of what this inflation story has become at this point. It's not aggressively high as it was 2 years ago, but it's not really coming down anymore either. And the question is it going to start coming back down? Is it going to tick up? How does Trump's policies play into that over the next year? But right now, it seems like the market is just disappointed in what the narrative has become, at least in the short term, which is higher rates because investors feel like the Fed will not be cutting this year, perhaps maybe at all. And that has been the key pressure on stocks. So will we get something different on Wednesday? Right now, at least what expectations are, looks like no, but perhaps there'll be a little bit of a positive spin, maybe.
Josh, how much weight is being put on earnings this time around, and mainly in comparison to what we've seen the last couple of quarters? Because you're right, the narrative certainly has shifted. Much of that focus seems to be on rates. We have bank earnings. We'll likely get a little bit more in terms of their outlook, obviously, for the next couple of months and the next year. But I guess how much of that optimism might be put to the test right away?
Yeah, I mean, it's a high bar, right? We're looking at FactSet's projections is for the S&P 500 to grow earnings by 11.7% in the fourth quarter. That would be the highest year-over-year rate for the S&P 500 in 3 years. So it's a pretty high bar for companies to beat. I think the key question too, Shauna, is going to be, we just talked about some of the things that people have been worried about for the rest of the year, right? So if rates are going to be higher than we initially thought, what do companies actually say about that? How does that impact banks? And you're going to hear from them this week and get a little bit more insight into, they need to put this into their models, right? And then give you and spit out a guidance number and tell you how that's going to impact them. I think similarly with Trump's policies, what do these companies actually say about what they think is going to happen this year? How much are retail companies thinking about tariffs? How are they planning for that? How is it going to impact their business? And then you add in a final thing that a lot of people are starting to talk about too, is the strong dollar, right? How are FX headwinds going to play in? There was interesting research from Goldman Sachs showing that investors actually often look through FX headwinds. If you miss on sales because of the international strong dollar sort of trade, your stock normally doesn't get hit as much. But in this environment where it seems like no stocks are really finding a lot of positive catalysts right now, when you have a negative reaction, how much worse does the reaction get, right? Because right now there just hasn't been a lot of appetite for a lot of these stocks, risk assets in general right now. So if you miss, you would have to think perhaps maybe that weighs even a little bit more than it normally would.
From what you're sensing and rounding up in some of the commentary from the strategists out there, does it seem like the econ data that you're really looking at this week, in addition to the earnings that we're going to be tracking, is the econ data enough to elicit some broader volatility swing?
Yeah, I think the thing with earnings, right, is that's a micro story. And it's good for the companies and good for individual investors that own those stocks. But unless you get a broad sense that things are strong from a certain sector and things are really starting to turn up, that's not going to be an overall market driver, right? That's not going to help you get stocks out of this slump, versus I think the macro data could perhaps do that. If you start to see rates come lower, the overall risk-off sentiment that you've seen market-wide, you're probably going to need that solution to come from the macro side, not just what certain companies say about their own individual businesses.
All right, a big week ahead. Josh Schaefer, thanks so much. Well, recalibration of rate cut bets continuing to weigh on equities as investors await two key inflation prints later on this week. Joining us now, we want to bring in Sam Stovall. He's CFRA's Research Chief Investment Strategist. We also have Kathy Bosch-Jancic, Nationwide Chief Economist and Senior Vice President. Kathy, let me start with you. Let's start on the inflation prints upcoming here. We certainly have seen the market very much focused on the rate story. In terms of the updates that we'll likely get this week, are you expecting further progress, or will we see a read here that brings about some of those concerns here, or brings them to the forefront here, that once again we are still dealing with sticky inflation?
Well, good morning, Shona. Happy to be with you. I don't think we're going to get any reprieve on the inflation front this week. When we look at producer prices, that will be the first inflation readings we get, as you mentioned, tomorrow. We think the headline increase is 0.4, so that is sticky. And then for CPI, we're looking, which is really the most important release, we're looking for an increase 0.3 at the headline, 0.2 at the core. What you're going to see is higher egg prices due to the avian flu. And when you seasonally adjust gasoline prices, that's going to boost the headline CPI number. Within the core, it's going to be a bit more moderate, up 0.2. That's not a bad reading. We expect some further easing in rental inflation and reversal of car prices and apparel prices. We think discounting in December really should help alleviate pressures there, and we'll probably see some outright declines. But overall, this inflation picture is not enough, I think, to tip the scales for the Fed to think they're going to start to cut rates anytime soon.
Sam, how should the shelter costs that most likely will have a more outsized impact and eggs play into the mindset for investors out there, especially as they're reading through these inflation prints?
Hello, Brad. Well, I think investors like myself would be agreeing with Kathy that we're probably going to see hotter CPI, PPI, and maybe even PCE later this month. The real question is this likely to be a trend that will continue into the year? Or, as we are projecting, that this will probably end up being a bit of a high watermark before we start reasserting that downward trend in inflation. So I think certainly that the Fed will be on hold until the second and fourth quarters of this year, when they will be cutting interest rates. So investors are going to be looking at 10-year yields, inflation, as well as earnings to decide where they should go with their portfolios.
Sam, talk to me a little bit more about why we are seeing the reaction in the equity market to the bond market moves here, because here we are, we have the 10-year yield not too far from that 5% level. What is it that's so problematic about these levels that's causing some of this risk-off trading action that we've seen?
Well, Shauna, I think it's because investors aren't really sure what is really behind the rise in the 10-year yield. Is it because of the new administration coming in with their tariffs, with their changes to SALT tax rates, and therefore the increase in the overall debt and deficit levels? Or will it be a concern that inflation is likely to be reversing course and heading higher, and as a result, the Fed will be slower to lower interest rates? And now, with only 2 rates on the table, rate cuts, will we end up with 1 or maybe even none? So there's an awful lot of uncertainty out there, and investors really aren't sure which way things are going to turn.
Kathy, how much probability would you place on a singular rate cut, which would be less than even the Fed was signaling?
So our baseline forecast, we're very similar to Sam's views. We do think there's a chance the Fed cuts rates in the second half of the year, and we see 2 rate cuts. But as you mentioned, if the data continue to come in as they are, meaning that let's also remember there's some good news here. The labor market and the economy is actually stronger than the Fed thought. That's in large part why 10-year yields are rising, and they may sit on the sidelines for longer than expected. But it's going to depend on the data and inflation stickiness. Our view is that the underlying inflation trend is still downward, so disinflationary. What we don't know at this point is what changes in tariff and immigration policy we have. So we've incorporated some increase in goods prices, and that probably dissipates, though, as the second half of the year goes on. So we're still hopeful that we get some Fed rate cuts, but again, it's going to be pushed off to the second half of the year.
Kathy, there's starting to be more and more talk here about the potential for rate hikes, actually, if we don't see further improvement, if we do see a reacceleration in inflation. It doesn't sound like you're too worried about that for now.
I think it's premature. I mean, I'm not surprised there's some discussion of that. It's premature at this point. What we're seeing again in the inflation dynamics, there's some really good news on the service side, and that's been the stickiest part. Rental inflation seems to be easing. Now we'll get some confirmation or not of that on Wednesday. Now, goods prices, which had been falling at a pretty rapid clip, that's where we've seen some turnaround. It's still deflationary, but at a slower pace. Now, if we get changes in tariff policy that puts further pressure on goods prices, that's where it could get a little tricky for the Fed. But we're not anticipating a huge surge in inflation that the Fed has to say, now we need to start to raise rates. And we think the underlying momentum in the economy is one of moderating, still solid, but moderating economic growth.
Sam, is there a top trade idea that really emerges as you think about the correlation between tariffs and what that would mean for inflation?
Wow, good question there. I think the real question is what kind of an impact is it going to have overall on the market itself? I mean, we've seen a 4.3% decline in the S&P 500. We've essentially seen all sectors in negative territory since the December 6th all-time high. And so I would tend to say for most investors, the best thing is to do nothing at this point, see which way things break out, because we're not even at a pullback level right now, meaning a 5% decline. And if we even look to approach the 200-day moving average, that brings us closer to about a 9% overall decline. So I think there is more volatility ahead, and that investors therefore should keep some powder dry.
So when you take a look at the moves of the dollar recently, we had the dollar hitting a 2-year high. And I bring this up in the context of earnings season because Josh Schaefer, our markets reporter, was just on set a moment ago talking about the fact that investors very much tend to look through FX headwinds when it comes to some of those biggest challenges facing corporate America right now. Do you think that's going to be different this time around, given the levels that we're seeing?
Well, not necessarily as it relates to earnings, because I agree with Josh that a lot of companies do end up hedging their currency exposure. And so with earnings now expected to be pretty strong in this final quarter of 2024, we know very well that management has done a very good job of managing expectations. So the real question is about demand from overseas in forward quarters, and that could be a problem. Also for investors who were looking overseas because of valuations being so attractive, well, they might not be so attractive if the dollar continues to strengthen as we think it will in 2025. Could actually provide some benefit to mid and small caps whose marketplace is more domestic, however.
Sam, Kathy, thanks so much for taking the time here with us today, pre-market. Really appreciate it.
My pleasure. Thanks.
Thank you.
An update on the California wildfires. Los Angeles and the rest of Southern California are facing a second week of fierce winds that are poised to fan the flames of wildfires that have killed at least 24 people and burned down more than 12,000 buildings across 40,000 acres in the Pacific Palisades and Altadena neighborhoods of Los Angeles. The National Weather Service issued a rare warning of a particularly dangerous situation beginning overnight Monday into Tuesday.
While good progress has been made on two of the region's smaller blazes, the largest continued to burn Sunday as thousands of firefighters tried to get the fires under control. AccuWeather is raising its estimates for damages and economic losses to as much as $275 billion. California Governor Gavin Newsom issuing an executive order aimed at helping Los Angeles rebuild faster once the fires are contained. As of early this morning, the Eaton fire was 27% contained. The Palisades fire was 13% contained. We'll bring you those updates as we get them. Much more on Yahoo Finance ahead.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's go to NVIDIA, ticker symbol NVDA. You know it. Accusing the Biden administration of threatening innovation and economic growth as the White House unveils new export limits on the sale of AI chips. The rules establish caps on the amount of computing power that can be sold to most countries and are set to take effect in 1 year. NVIDIA's Vice President of Government Affairs, Ned Finkel, writing in a blog post, quote, "Rather than mitigate any threats, the new Biden rules would only weaken America's global competitiveness, undermining the innovation that has kept the U.S. ahead." There you're seeing that statement in part. He goes on to write, while cloaked in the guise of anti-China measure, these rules would do nothing to enhance U.S. securities, and the new rules would control technology worldwide, including technology already widely available in mainstream gaming PCs, consumer hardware, and ultimately talking about how this limits or weakens, from their perspective, America's global competitiveness.
Yeah, Brad, what stuck out to me in this statement here from NVIDIA, and also what we're hearing from industry inside groups, is just the focus here. They're looking past the Biden administration, really trying to appeal to the Trump administration. We're 1 week out from the inauguration. And within the statement, that very last paragraph here from NVIDIA, they talked about the fact that they said, quote, as the Trump administration demonstrated, America wins through innovation competition by sharing technologies with the world, not by retreating. Also went on to say, we look forward to a return to policies that strengthen American leadership. Semiconductor Industry Association was also very quick to criticize this rule from the Biden administration, also focusing their efforts, suggesting that new policies should be designed by the incoming Trump administration. So they're doing all they can to appeal to the incoming administration, trying to get incoming President-elect Donald Trump here to potentially appeal some of these laws that will be put into place. In terms of the context of how big of a deal this is for NVIDIA, you can see the reaction on the screen right now, off just about 4%. A lot of this is just some of that jitteriness that we're seeing surrounding the market about what that backlash is going to look like from China, how far and how deep some of these back and forth tit for tat curbs can go here, and ultimately who is going to then be holding the bag, who's going to have the biggest impact, or who is going to suffer the most from these. And you could take a look at even just NVIDIA's concern from this. It's obviously a challenge, a headwind that they are watching very closely.
Yeah, about an 11% drawdown since last week. If you take a look at the 5-day chart, we should also note that this company did just see a new all-time high last week. And so we'll see, even with this response to the outgoing administration, how they're able to be successful in cozying up to the incoming administration.
Let's take a look at Apple. Apple losing market share, selling 5% fewer iPhones globally in the last quarter of 2024. The company's lack of available AI features in China causing it to lose ground to Chinese rivals. That was one of the things that was pointed out. iPhone slipping a point to 18% worldwide market share in 2024. Lots of talk from analysts here, analyst community, over the last several months. There was some fear that the latest iteration of the iPhone would be a bit underwhelming. Lots of criticism surrounding Apple, the fact that they were a little bit too late here, or late in the game to AI, and the fact that it is not available in China. Obviously a headwind here for the company, at least right now. They are giving up some of their market share to Android device makers in China. We have Xiaomi and Vivo. They are just two of those that are gaining a little bit of ground there. Apple marking a 2% sales decline for the full year. The reason why that is significant, it actually came at a time when the global market grew 4%. So again, they are seeing a bit of their market share decline. Just whether or not this is the start of a larger trend is what analysts and what investors are trying to figure out.
When's the last time you talked about Motorola? Oh yeah, today. And this is why, because Motorola was one of the names that actually saw expansion. Challenger brands like Honor, Motorola, the Transsion Group, also Huawei making a resurgence in China, all part of this global market recovery. So prior to today, it's probably been years and since we've been talking about Motorola as a core competitor within this industry. Now they still have a ways to go. You were mentioning some of the brands that have really seen their year-over-year unit change growth. Vivo, Oppo, two of those that saw 9% for Vivo. Actually, Oppo went down by about 8%. But then additionally here, some data from the research director, Tarun Pathak from Counterpoint Research, saying 2024 was a year of recovery and normalization. That was a word that we heard tossed around a lot at the start of 2024, and that came to fruition here. Normalization after a difficult 2023. Smartphones continuing to be an essential product. I don't know if Foldly is essential, but we'll see how that plays out over the course of this year. You've long heard my banter about whether or not we need Foldly phones. I'm starting to come around to it just a little bit. We'll leave that discussion for another day. And we'll see how it's pivotal to people's lives, as he says as well. But macroeconomic pressure softening. The market's starting to show signs of recovery from Q4 2023. It's now grown, forget this, 5 consecutive quarters. All markets showing growth, led by Europe, China, and Latin America.
We also had commentary from Meta CEO Mark Zuckerberg. He slammed Apple for its lack of innovation. This all came during an interview with Joe Rogan over the weekend. Let's take a listen.
You know, they haven't really invented anything great in a while. It's like Steve Jobs invented the iPhone, and now they're just kind of sitting on it 20 years later.
This was out at the end of last week here, and it's interesting. Zuckerberg is very much on the offensive. He's trying to change the company in multiple ways, trying to appeal to the Trump administration. Now he's going up very critical of the Biden administration as well during various parts of that interview. But what he said specifically about Apple, he's really taking them on, criticizing them for the lack of product innovation, talks specifically about Apple's Vision Pro headset. It's also important to point out that Meta has its own virtual headset called the Meta Quest, so there's some competition there. But he was basically saying that they stop applying their random rules, Meta's profit is going to double. How you get there, a little bit of questions surrounding that, but shots were fired.
Look, I'm old enough to remember that when Meta was trying to come up with its own smartphone or any type of device and missed out on the smartphone device wave, they had to be able to make sure that they were giving data to some of the smartphone providers. That was a scandal in itself in how that data was used later on down the line. Mystery figure that we had right there. But ultimately, one of the massive things that we're going to be watching going forward is how they lean further into hardware in order to make sure that they don't miss out on the next wave. And they've been trying to push people into the metaverse, trying to make the headset the next smartphone. We'll see if that happens. The cost probably has to come down a little bit. Oh yeah, they've also been leaning into other strategic partnerships in the absence of having that hardware device. They've also been trying to get into homes as well here. So besides the home assistants, besides some of the actual headsets and waiting for those prices to come down, or for the artificial intelligence to be so grandiose that consumers are saying, I can't go without having this piece of hardware in my life, they're probably not going to have a hardware, and hardware is hard is the famous adage within the technology industry. And Meta has had to make sure that on the software side and experiential software side, they can be far more superior, and advertisers flock to that solution rather than consumers purchasing into that hardware at this juncture.
Yeah, well, Rogan brought up the conversation when it comes to Apple, but Zuckerberg just really took it and ran with it. I had an opinion about it, so here we are.
Well, finally, let's talk a little Tesla here on the day. Tesla surpassing Audi in global car sales for the first time. Audi struggling with competition in Europe and China, selling 1.67 million cars in 2024 compared to Tesla's 1.79 million cars that were sold. Still, Tesla posted an annual delivery decline for the first time in more than a decade. Shares of Tesla, they're down right now by about 3.2% here, but it's been an interesting run, of course, since the election, and now that Elon Musk has a new best bud that he hangs out with in President-elect Donald Trump. We'll see exactly where that benefits Tesla. We've heard multiple notes come out talking about the larger EV landscape and how that annexation to Trump actually benefits Tesla versus the rest of the industry.
Yeah, we have a moment chart up on the screen here. It's a decline of 1.5%. But if you take a look at the 3-month, you really will see that incline and really the astronomical growth that we've seen since Election Day. This story, though, really has a little bit more to do with the weakness that we're seeing within Audi's business versus outperformance here from Tesla. Because when you come into the fact, and you mentioned it there, Brad, they are having some issues still, right? They posted their first annual deliveries decline. They only narrowly retain their lead over BYD as a top seller of EV. So you talk about EV adoption and some of the headwinds that we could see here for the industry at large over the next couple of years. Tesla obviously isn't immune to that. Of course, though, there are analysts like Dan Ives making the case that Tesla is best positioned, just given the market share that they do have and given their customer reach right now. All right, keep it right here on Yahoo Finance. We got much more of your market action ahead. Stay tuned. You're watching Morning Brief.
And there you're taking a look at today's bell ringers at the New York Stock Exchange, where you have Citi in celebration of Martin Luther King Jr. Day, which is next Monday, but also coincides with Inauguration Day. Citi at the New York Stock Exchange. At the Nasdaq, you've got the biotech index getting some funfetti, ringing the opening bell to kick off today's trading activity. Let's do a quick check of the markets here as we're just after the opening cross. The Dow Jones Industrial Average opens lower fractionally as it may be. It's to the downside by about 0.1%. The S&P 500, you're going to see that down as well here to begin today's trading session. You're seeing it lower by about 0.9%. And the Nasdaq Composite, we're seeing that calibrate here just a little bit, and I'll populate this chart for you just so we can get a longer run view of the slippage that we've seen over the past few sessions here. Opens the day lower by more than 1.3%. Let's take a look at some of the sector activity as we're beginning today's activity, today's trade as well here. Energy, it's leading the pack, while technology kind of mirroring what we're seeing within the Nasdaq Composite. You're seeing technology bring up the caboose. It's down by about 1.4%. And speaking of the Nasdaq, let's take a look at the Nasdaq 100 here. And there you're seeing the culprit for some of those deeper declines. NVIDIA is down by over 4%, well, roughly 3.5% to start today's trading activity. Things moving around quite a bit. Meta also down by about 2%. So a lot of slippage, a lot of red that we're seeing in some of those mega cap tech stocks as of right now. For a deeper dive, let's get into Yahoo Finance's Jared Blickery for a look at what is moving. Hey, Jared.
Thank you, Brad. We've got a lot of technicals in play here. So let's start with the Dow. Dow simply has been down 5 of 6 weeks, and you can see it's down about 54 points today, 41,800. But I'm looking at the S&P 500, and let me show you a 3-month view. We are now in a confirmed downtrend, at least on a short-term basis. We have a series of lower lows and lower highs that we can see here. And importantly, this is putting in a head and shoulders top formation. And I was speaking only a few days ago about the necessity of waiting for confirmation, but now we are getting the confirmation of that potential top, and we'll have to see if that plays out. Sometimes you get a pop above, and it was a false breakdown, so that's something we'll keep in mind as a possibility as well. Want to take a look at the VIX here, because that has popped over 21 again. You can see that spike up here. That was that surprisingly slightly hawkish FOMC announcement by Jerome Powell in the middle of December there, so we are heading higher. That is a risk signal there. And then here's the 10-year T-note yield. We are camping out. This is going to be a 3-year chart. We are camping out by 1-year highs right now. And if you take a look at the US dollar index, we are forging multi-year highs. And you can go back to 2022. It's just been really interesting to see these things play out. And I'm going to show you the sector action today. As Brad was saying, energy is in the green here by a large amount. Energy up almost 1%. That's XLE in the upper left there. And then tech is the only underperformer, and we've seen a lot of giving back of some of those recent gains, not just in the semiconductors or software, but also unprofitable tech, so across the spectrum. And I would say this is also a little bit reminiscent of going back to the beginning of this bull market a few years ago, how energy and tech would change places as leaders and laggers on any given day. So we do have that still in effect. Want to get to the Nasdaq 100 here, and you can see a sea of red, and if I put this on a 2-day, you can see it gets a little bit worse. We've just seen bouts of selling. NVIDIA down 6.6%, Apple down 4.4%, kind of slicing through some key levels there. And I'm going to close on crypto because the risk sell-off today extends into the crypto assets. We see Bitcoin down 3.9% over the last 24 hours. And if I pull up a chart here, you can see we got some big levels in play. 90,000, hard to see right there, so I'll bring it down to a 3-month chart. But you can see 90,000 has been the level to maintain, and we are right there at the Rubicon. Shauna.
Yeah, all right, Jared, thanks so much. It's time now for today's strategy session. Investors having a slew of big banks' quarterly results to digest later this week as earnings season gets underway. Joining us now, we want to bring in Kenny Polcari. He's Slatestone Wealth Chief Market Strategist. Kenny, it's great to have you here on set with us. So I think the big question is whether or not earnings is going to be enough to turn around this decline that we've seen.
Well, you know, it's interesting. They should be, but we're in a different tone, right? There's a different sentiment now about where people feel about the markets and where they feel about the Fed and where they feel about inflation. So earnings may be good, but if people are really worried about the Fed and inflation, that's going to I think that's going to trump. I hate to use that word in that way, but I think it's going to trump, the way people feel.
Who's on your Mount Rushmore of the commentary that we're going to hear from CEOs this earnings period?
Jamie Dimon is always my favorite.
Okay.
First of all, he's the first one to present as a Dow stock, right? That's the official start of the season. On it'll be Wednesday this year. We'll hear from JP Morgan. But I always enjoy hearing from Jamie Dimon because I think he hits it on the head every single time, right? He never seems to disappoint. And he's got a really kind of methodical, robust way of looking out in the future and talking about what he thinks how the bank is going to do, what the economy is going to do, what he's expecting from the markets and from really the consumer. So he's my favorite.
Kenny, when it comes to what we'll likely hear, though, I guess there's lots of talk about whether or not the economy is going to hold up, what we're going to see when it comes to Fed rate cuts. What is the most important thing for investors to listen to that's going to give us that better?
So I think this earnings season, I think you have to pay attention to loan loss reserves. Loan loss reserves is that account that the big banks they fund to protect them against defaults, right? So mortgage defaults, credit card defaults. If we see those loan loss reserve accounts increasing in value, if they start putting billions of dollars into the loan loss reserve account, that gives you a sense of what they really expect, right? Are they expecting a tougher time? Are they expecting lots of defaults? Are they expecting people to default on their credit card payments or on their mortgage payments? That's going to, for me, that's going to be a key as a consumer and as an investor, right? Yeah, sure, we'll hear about their M&A activity and all that stuff. But when it comes to really talking about the consumer and the economy, you have to watch what they're saying about their loan loss reserves.
When I was talking to Delta CEO Ed Bastian last week, especially around their earnings results and what they're forecasting going forward into the future, he's clear and quick to acknowledge that this is a multi-tiered consumer that we're talking about here, where you've got premium holding up, but at some of the kind of other tiers, you're seeing some real stress showing.
Right, and I'm not necessarily surprised, right? Because I think there is a certain consumer that is feeling very stressed, right? And if inflation starts to tick up its head, which it feels like it's going to do, that's going to just cause more stress, right? You saw on Friday in the NFP report that average hourly earnings year over year actually ticked down just a little bit, but it ticked down. This at the same time that we're seeing inflation beginning to tick up. So once again, we're going to run into that problem where is inflation going to run ahead of where average hourly earnings are, and that's going to create more stress, especially on kind of the middle income earner to the lower income earner.
Kenny, should the Fed be cutting again this year?
Absolutely not. And I am in the camp that not only are we not going to get another cut, but the risk is to the upside. That in fact they're going to turn around and raising rates if inflation really rears its ugly head.
What will trigger them?
Yeah.
Sorry.
So I think there's going to be a couple of things. I think that this 100-point basis cut that they made the last 3 months of the year is starting to fuel inflation because they stimulated the economy at a time when I don't think it needed to be stimulated. I don't think rates at 4.5 and 4 3/4 is restrictive at all. Historically, it's very normal. And so I think that's part of it. I think the other part of it is, look, there's this new administration coming. We just saw Biden impose all kinds of sanctions on Russia, which is going to send the price of oil higher. And as the last couple of days have seen it spike higher, today it's higher. And higher oil prices are going to contribute, once again, it's going to help ignite that inflation monster because energy prices transcend across all sectors of the community, transportation, production, all that stuff. And so that's a concern. And then you have this new administration coming in, and there's lots of uncertainty around what they're going to do, how much they're going to spend, what they're not going to spend. Are we going to get the tax cuts? Are we not going to get the tax cuts? And so I think there's a lot of headwinds that are conflicting.
What's your top idea going into this next administration?
So I think you have to look at it. You have to understand where I am in the life cycle, right? I'm 63, so I have a different outlook than you do, right? You've got more time. I don't. So for me, I'm going to be much more stable. So I'm looking at healthcare, which was the underperformer in 2024. Actually, I think it ended the year slightly lower. But some of those big names, Merck and Johnson & Johnson and Lilly, some of those names have gotten absolutely crushed. They're on sale. They're down more than 25%. That's a great sale, right? And so for good names like that are good dividend payers, Johnson & Johnson and Merck, they're 3.5% divvy payers. Yeah. And they're the biggest names in the sector. So I like healthcare. I do like financials. I always like tech, but I'm not chasing tech. If tech goes on sale, I'll absolutely buy more because the future is tech.
All right. Well, that transitioned us perfectly to our next story. Kenny, thank you so much for taking the time.
Always a pleasure.
Today. Appreciate it. Well, stock that we are watching at the open, Moderna, plunging with shares lower here after they also lowered their 2025 sales guidance by roughly $1 billion due to a few potential headwinds later this year as the biotech company continues to cut costs and expand its portfolio. Here just after the open, you're seeing shares move lower by a little bit more than 23% as of right now.
Yeah, when you take a look at the degree of this drop, it's actually the lowest level that we've seen from Moderna here since at least April of 2020. So putting that in perspective. Also, the revised guidance that we did get here for revenue for 2025, the range now $1.5 billion to $2.5 billion. That's down substantially from what they saw previously. They saw a range of $2.5 to $3.5 billion. So that pretty much, or to an extent, explains the degree of the decline that we are seeing right now. Just furthermore, into this update that we are getting, product sales last year were just around $3 billion. So Moderna is saying that it expects to accelerate and expand its cost-cutting plans, aiming to reduce that spend by $1 billion in 2025 and by $500 million in 2026. So again, when you take a look at these efforts here going forward for Moderna, obviously a lot of this being driven by the fact that we've seen slow demand for COVID and also RSV shots, and that's having a direct impact on Moderna's bottom line.
Yeah, 3 pillars here that you're going to be wanting to watch and grade Moderna on going forward here, and they kind of line it up in these 3 strategic priorities: driving sales growth, number 1; number 2, delivering up to 10 product approvals over the next 3 years, and then also reducing costs across their business. We'll see what form that takes shape.
And it's also quick to point out, and I'm sure we're going to be getting more commentary about this once the healthcare conference, JP Morgan's healthcare conference, gets underway here this morning, but also just the uncertainties surrounding the Trump administration, especially for vaccine makers, just how they are navigating this uncertain time, what it ultimately means here for their strategy, for planning here over the next several months and potentially years.
Absolutely. We'll be tracking that. Also, time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at China's trade surplus. Maddie, what you got?
That's right, Brad. Want to take a look at the surplus of trade coming out of China, hitting $1 trillion. This is a record you can see here, hitting the highest level on the screen behind me. As a reminder here, what is a trade surplus? It is the amount to which the exports are outpacing imports, and this time hitting a record $1 trillion in terms of outflows from China. That's a 21% increase from the year prior, and that also represents 10% of China's economy. You can see here, since the pandemic in 2020, huge lift to the upside in terms of that trade balance surging, right? And this is indicative of the Chinese economy slowing, really relying on exports to shore up their economy. But also some economists pointing out to me this morning that this is a sign that the Chinese economy is in a deficit right now. It's also a sign that potentially we are seeing businesses ticking up their purchasing of goods and services from China ahead of any potential tariff policies from the Trump administration. When you look under the hood of this data, you see that Vietnam was one of the biggest recipients of those exports from China. So if you're Vietnam, you slap a Vietnam label on that Chinese good, and then you don't have to undergo those tariffs that the Trump administration may be putting on China specifically as we move forward. So that is part of the argument that these tariff policies do just kind of create new markets as opposed to potentially punishing some of the nations that they are trying to punish, like a country like China here. I also just want to quickly mention here that we will get more clarity potentially in the next week or so when Trump does head into office, and that'll of course be a week out from today, Shauna.
All right, Maddie, thanks. Coming up, bank earnings on deck this week. We have the top themes to watch. That's coming up when we return. Big banks officially kicking off earnings season this week. Citi, JP Morgan, Goldman Sachs, Wells Fargo, just some of the names set to report. Those four reporting on Wednesday. Bank of America, Morgan Stanley, they're set to report on Thursday. We want to bring in Gerard Cassidy. He's RBC Capital Markets analyst. Gerard, when it comes to some of the themes that we're unpacking this week, I think the big question right now with the rates discussion where it is about whether or not banks are going to live up to that high optimism. What do you think?
It's going to be very interesting because certainly the fourth quarter results are expected to be good. You're going to see stronger investment banking activity. Credit quality is expected to remain very healthy. And we think that we'll start to hear about some improvements in the net interest margin. What's interesting is what the outlook's going to be for 2025. That's what investors are likely to focus in on. Many of the banks will give us 25 guidance, particularly for their revenue line known as net interest revenue. And the net interest revenue line is impacted by obviously earning asset growth, particularly loans, but also the net interest margin. And when you take a look at where rates are today and the expectation now that the Fed funds rate may not drop much more from where it is today, we currently have a positive sloped yield curve. We haven't seen that since 2022. This is very positive for net interest revenue growth. Would also suggest that if the U.S. economy is going to grow 2 to 2.5% in 2025, which it appears likely at this time, and you put on 3% inflation, that's nominal growth of over 5%. And we think that loan growth has been held back over the past 2 years due to some uncertainty on the regulatory front regarding capital levels. We think loan growth could really be the upside surprise in 2025, leading to better than expected earnings for the banks in 2025.
Gerard, I wonder, as you're mentioning regulation and what deregulation could mean for some of the M&A volumes as passed through to some of the investment banking results for banks, especially as they're going to be communicating their own forecasts and what they anticipate the broader market may look like.
Brad, it's a good point because in the current administration, the Biden administration, they made it very clear from the very early days they were going to scrutinize M&A activity, and they have their Justice Department, the Antitrust Division, has prevented or blocked many deals. In fact, it wasn't the Antitrust Division, but as you know, the U.S. Steel, Nippon Steel merger was prevented. Both those companies are suing the U.S. government to get that deal done. So I think what you're going to see is under the new Trump administration, if you look back to his first term, it's going to be a more business-friendly administration. And I think you're going to see quite a bit of activity, of M&A activity in all industries, the banking industry as well. And that should be bode well for the advisory revenues for all of the investment banks in 2025.
Gerard, who is best positioned given that environment?
You can play it a few ways. Of course, Goldman Sachs, Morgan Stanley are the pure plays, but also the money center banks, Bank of America, JP Morgan, Citi are another way to play that as well.
Okay, so all of these things considered, do you have a kind of favorite pick as you're looking across the broader banks and the growth? Because it seems like for all of the diversification that these banks have talked about over the past few years, that some of those measures are really going to need to come to fruition in 2025.
No, you're right, Brad. And I think when you take a look at the diversification and you put your thumb on it, it points to the larger banks like Bank of America. We think they're very well positioned. Based upon the public filings of last year, Berkshire Hathaway was a big seller of the stock, and I think that selling has eased up. So therefore, that downward pressure shouldn't be there in the first half of the year, at least. And under the leadership of Brian Moynihan, the CEO, he's led this company out of the doldrums of 08, 09, risen from the ashes. He's a conservative CEO, and because of that diversified revenue mix that they have, they can obviously benefit from the consumer banking business as well as investment banking and commercial lending. Plus, they have one of the lowest cost deposit bases in all of the United States. And let's assume for a moment the Fed funds rate stays at 4% 4.25%, and you think of commercial loans and other assets that are priced off the front end of the curve, that's a very nice spread when you have low-cost deposits. Plus, they unfortunately in 2020 and 2021 took duration risk in their bond portfolio, but now as a result of those bonds going to be paying off in 25 and 26, they will be paying off and rolling over into higher yielding securities, which will also help that net interest margin.
Gerard, when we talk about the increase in volatility, the expected increase in volatility that we'll see, how big of a catalyst is that for trading desks this year?
Yeah, no, it's a very good point, because Shauna, volatility is what you need to really drive those markets higher or trading revenues higher. And you saw it, really stand out tragically with the invasion of Ukraine from Russia in the first quarter of 22. The volumes and volatilities were really high. Trading revenues were quite strong. So volatility is important. The corollary, or I should say the opposite of that, is less volatility should lead to stronger ECM business. That's the IPO business. So it's kind of a yin and a yang situation. But certainly, if there is increased volatility due to the uncertainty on inflation as we go forward, certainly the trading revenues could benefit from that. And the trading revenues, of course, for all of the big investment firms are much greater than the investment banking revenues.
Gerard, thanks so much for taking the time here with us today, just after the opening bell. Appreciate it.
You're very welcome. Thank you.
Certainly. Coming up, everyone, we're taking a look at oil prices, or not oil anymore, retail stocks on the move. That's on the other side. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's take a look at a pair of retail stocks we're tracking this morning. Macy's and Lululemon, both releasing some early estimates for the holiday season data. Lululemon raising its Q4 2024 sales and profit targets, expecting 11 to 12% growth year over year. Meanwhile, Macy's now expecting net sales to come in at the low end or just below its previous outlook. Macy's also planning to expand its 51st strategy and add an additional 75 locations in fiscal 2025 here. And we're also taking a look at some of the expectations for adjusted diluted earnings per share to be in line with the previously issued range of $1.40 to $1.65, and then net sales to be at or slightly below the low end of the previously issued range. That was $7.8 billion to $8 billion.
Well, when you take a look at Lululemon, a little bit more upbeat, the reception that we're hearing from the street, raising their guidance here for fourth quarter sales, are expecting that to surpass the street's expectations. They expect revenue to rise between 11 and 12%. What is driving this? The CEO talking a little bit about the success that the company has seen internationally, also expanding online sales. Also went on to talk about the fact that they're selling more products to men, and they see that as a winning strategy.
It's me.
All right, it's you. That's your parka. All right, well, that does it for Morning Brief. Keep it right here. Catalyst is next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we break down the market sell-off and push ahead to CPI later this week as investors prepare for the latest read on inflation.
Plus, 1 week until presidential inauguration, we will look at what to expect for trade and tariffs.
And the JP Morgan Healthcare Conference kicks off. We'll take a look at the biggest themes investors are watching as M&A optimism tops the list.
Let's take a look at some of the market headlines to start the hour. We're taking a look at a bit of pressure here as the market really focuses on higher rates and how problematic the surge in yields that we could see here could be here for the equities market moving forward. You've got the S&P and the Nasdaq both in negative territory. You've got the Dow, though, holding on to slight gains up just about 150, 160 right now. When you take a look at the bond market, flipping over to yields, the steady climb higher in yields has certainly shaken investors' confidence. We're seeing a bit of a give back here this morning, off just a bit, but still right around that 477 level. You had the 30-year yield also briefly crossing through 5%. Taking a look at oil, when you take a look at the climb in oil, you've got oil prices that did hit. You've got Bitcoin on the screen right now, which is off 3%. But if we could flip over to crude, you had crude briefly crossing. You have Brent right now. Brent's actually right above $80 a barrel. You have oil hitting a 5-month high. U.S. sanctions on Russia. The questions there just about supply concerns there. That's starting to creep into the market. That's pushing crude up to nearly 78, and you've got Brent crossing $80 a barrel.
We are coming off a down week for stocks under pressure from rising Treasury yields. Friday's stronger than expected jobs report sent the 10-year yield to a 14-month high as expectations for further Fed cuts dwindled. For more on how economic data could continue to impact yields, the broader market, and those big tech names, we got Dan Suzuki. He is the Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, it's great to have you on here. How much of a challenge is this bond market going to continue to be for stocks?
Well, I think it's going to come in fits and starts. I mean, I think what we're seeing right now is that the closer you get to pricing out cuts on the way to maybe hikes down the line, and the closer that the 10-year yield gets to 5% and to cycle highs, I think the more the market starts to worry about what the implications of that are for valuations, credit conditions, liquidity, et cetera. And I think that's what you're going to see. I think that we could get a bit of a reprieve here from just the sole focus on rates, because we've been in this sort of earnings vacuum. But obviously, you guys have been talking about this morning, we're about to kick off earnings season. So as you get the earnings season and that comes more into focus, I think you'll get to see some pretty strong numbers. And I think that the market's focus will be on who are the companies that have the operating leverage that are able to offset any of the negative impacts of that financial leverage that gets hit by higher rates.
Dan, talk to me a little bit more about market sentiment right now. When we talk about what's driving the message, or driving the narrative, the why behind this. When you see yields at the levels that they currently are right now, why is that such a challenge here in the short term?
Well, I think the story that's really been one big driver of the market sentiment and the markets, the strong markets overall, has really been that of liquidity. I mean, we've seen an unprecedented amount of liquidity driven by an unprecedented amount of stimulus over the last few years, and I think that combination has really gotten people, on top of the fact that we've been in basically the longest economic expansion ever. There's a lot of positive sentiment and high expectations out there, and I think that's really the liquidity story is the crux of that. And so as you look going forward, higher rates, obviously not good for liquidity. And so I think that's why people are starting to worry about, because higher rates, the more you have to start to worry about valuations, and these valuations are high, and there's a lot of companies out there with extremely high valuations today.
Well, it's interesting because in the notes you sent over, you mentioned the risk of corporate profit stalling, which would, of course, be a challenge for earnings and therefore the broader market. Does that mean you think we are heading towards a bear market similar to what we saw back in 2022?
I think it's possible down the line. I mean, I think that's going to really be a function of how much earnings roll over. I mean, I think you don't want to get too far ahead of yourself, because I think that right now, the story is, sort of act one for this year is that earnings are probably going to be stronger than people expect. But at some point, midway through the year, our expectation is that earnings are going to peak out and stay initially quite strong. And so I wouldn't necessarily worry about the implications of an immediate bear market, but the worst that earnings growth slows down, and again, I don't have that crystal ball, and the more that it looks like we're going to go into a profits recession down the line, maybe in early 2026, the more you have to start to worry about, potential for a bear market, especially if at the same time, the Fed's talking about rate hikes and liquidity is tightening up.
Dan, how real is this talk about the potential for rate hikes?
Listen, I think that, we're all sort of going back to where, the Greenspan era, we're sort of dissecting every word and phrase and sort of, clothes that Jay Powell's wearing. I think that ultimately it's a little bit more simple than that. I think if you want to know what the Fed's going to do, you really just look at growth, because growth is going to drive inflation. Inflation is going to drive the Fed. And at the moment, growth is coming in strong. And if it continues to accelerate, which it may or may not do, the more you see those signs of growth accelerating, I think the more realistic it is that the Fed's going to hike. I mean, we're basically priced out almost all of the cuts for this year. So the next step from a market's perception perspective, whether or not they go through with it, is, another leg of stronger growth is going to be, the driver for market to price in hikes at some point.
I want to get your take on a chart I saw from Kevin Gordon over at Charles Schwab this morning, basically just pointing out the fact that the gains that we saw after the election, that huge swing to the upside in market optimism, has completely erased itself as of the market open today. What do you make of that dynamic, just that huge run to the upside that we saw on November 7th and in the months and weeks after that, and then the kind of return back to home that we've seen after? What does that tell you about how defensive investors need to be positioned as we do head into another question mark for the 4 years of policy to come ahead here?
Yeah, I mean, I'm sort of very happy that it kind of happened this way, because I mean, I've been saying forever that it just, in general, you don't want to be trading around elections. I mean, there's, every time you look at every single election cycle, the obvious story, people jump on that bandwagon, and pretty soon after you see that, the trades go the other way. I mean, dirty old energy has been the best performing thing within the Biden administration. It was the worst performing thing within the Trump administration. These are not the obvious election implications, for these elections. And I think you're starting to see the same thing now, where in the immediate aftermath of the election, everybody priced in all the positive implications of a Trump administration without thinking about what the negative implications are. From a market perspective, higher growth, all these inflationary policies, the big implication is that you're going to have higher rates. And so I think the market's now factoring in that it's not just a good story, the good comes with the bad. And I think you're sort of back to where we were at the start. So I think that is a normal phenomenon post-election, and I think it makes a ton of sense.
So talk to me then about how that impacts investor positioning. Does that mean that names like the big tech, large cap names become defensive in this environment?
Yeah, I think that really that's going to come down to earnings, right? So I think as long as their earnings stay strong, these have some of the cleanest balance sheets and some of the strongest growth in the business. I think they'll be very perceived as being very defensive. I think the sort of the unappreciated risk with these stocks is always that, people underestimate how cyclical they are. So I mentioned, that there's a good chance as we get to the later part of the year, earnings growth is going to be slowing. I don't think that these companies will be immune from that. In fact, I think unfortunately, for the people that are very bullish on these stocks, their cyclicality is as cyclical as you've ever seen. I mean, you go back to the 2022 profits recession, they led the cycle down, and then they've since led the cycle up. I think if we go into another slowdown, they'll be very big participants of that. And so I think that is going to lead. So if their earnings growth starts to roll over, clearly I don't think they'll be perceived as defensive any longer. But between now and then, any kind of ups and downs and wiggles and concerns, there could be an element of looking toward them as defensives, at least perceived defensives.
Certainly have seen that. All right, Dan, great stuff. Thanks so much for taking the time to join us here. We really appreciate your insight.
Yeah.
Mark Zuckerberg is sitting down with podcaster Joe Rogan for a 3-hour conversation that was published on Friday, just days after Meta loosened its content moderation policies for Instagram and Facebook, also announced the end of third-party fact-checking in the U.S. Soon after all this, Meta also announced that it was ending many of its internal training and hiring efforts aimed at making its workforce more diverse. This follows some similar moves that we've heard from Amazon, from Walmart, Ford, McDonald's, just to name a few. Joining us now, we want to bring in Marcus Collins. He's a clinical assistant professor of marketing at the University of Michigan. And it's great to talk to you again here, Marcus. Let's talk first just about maybe the why factor that's at play, because a lot of times when we're hearing from these companies, they're citing cost-cutting measures, they're citing maybe some internal changes that are going on. I'm curious from your perspective, what is it being driven by?
I think that this is a crisis of convenience over conviction, and that leaders in these organizations are following where the wind is blowing. The populace seems to be moving in this direction, and therefore they follow suit. But back in 2020, when we saw the public execution of George Floyd, the populace seemed to be going towards being much more cognizant and aware of the social forces, the systematic places or forces that are in play that are disincentivize or disadvantages people of color. That this push towards diversity being important. So we saw so many companies race out with their statement about we're here for diversity. We have all of these incentives, all of these measures put in place to allow us to achieve that because we thought that they were convicted. And what we realized is over the years that those programs started to be pulled back, so much so that they're being eliminated altogether. And what we realized is that this wasn't a matter of conviction, it was a matter of convenience, that they're going to move wherever the wind blows, which says to us that they're not terribly invested in us.
It makes me wonder, too, what you think about the path forward here. Obviously, Elon Musk saw a very profitable run following the election result, and now some have argued Mark Zuckerberg is kind of following suit. To what extent do you think that other big tech names are going to jump into the same camp as Musk and Zuckerberg moving forward?
Unfortunately, these phenomena tend to become very contagious, that when many of the big players move first, they create a permission structure that allow others to move as well. Those who are, of course, not convicted. But you see a company like Apple who says that, no, we're not pulling back or at least we're not making strides to pull back our diversity, equity, inclusion programs because we believe in a thing. And this is what sort of creates the foundation here, is that those who believe and those who do not. And while those who are racing towards what seems to be the new trend, we realize that they weren't in it to begin with. And when the tide turns back to where there's going to be a focus prayerfully on diversity, equity, and inclusion, that when they start to kind of change their tune, then there should be questions asked. Well, what happened in these moments? It's the people who stand up when it's not convenient, when it's not popular. Those are people that we know that are about this life. And those who see the world the way those companies do go, that's the company for me, and they will win in the long term. This becomes a matter of short-term gains versus long-term impact.
Marcus, talk to me a little bit more just from an investor, purely investor perspective, the business standpoint of this. What are some of those longer-term implications?
Well, from a business perspective, the long-term implications come from talent acquisition. That, this is a marketplace, and talent they're looking at all the different options in the market and saying, where am I going to bring my talent, my capabilities, my expertise, my brilliance? And when we look at the marketplace and we start to look at these companies and say, well, where I'm going to go, you start to find people who have the privilege of making those decisions, saying, I'm not going to work there because I don't agree with the way they see the world. I don't agree with the way that they have made decisions along the lines with regards to matters that are important to me. There are companies or people or their talent who will say, I'm not going to work with that company because they don't believe in climate change. I'm not going to work with that company because they don't believe in these matters that are of great import to me. And for an organization in the long run, that is unbelievably important. Because the most powerful thing, the most important thing for any company is not what they make, is not what they create, it's the people that they hire. And the people that they hire determine how the company actually performs. What Peter Drucker erroneously is attributed to saying is that culture eats strategy for breakfast. And what makes up the culture? It's the people.
Absolutely. It makes me wonder, too, about the people on the other side of these platforms and the reaction function that you talked about in the beginning of our conversation, Marcus. What do you make of that reaction from folks? We have seen the likes of message boards of internal employees talking about the rollback of DEI at Meta, for example, but we haven't necessarily seen mass cancellations of Instagram accounts, Facebook accounts. Talk to me about how you would characterize the public reaction.
I think the public is still in the midst of discourse. You know, this is why companies start to turn off their message boards, because they know that discourse is the precursor, is the antecedent to action. So we keep people from talking, you get people from acting. Keep people from acting. But as the discourse begins to brew, I think you'll start seeing people not necessarily organize right away, but to try to change their perspective. I mean, this is how culture is negotiated. This is how decisions are created. They're not manufactured in our minds singularly. They are collectively negotiated and constructed, and therefore we behave accordingly. So I think that what we're going to see over a short period of time is a negotiation process. And as a result, we'll start seeing people making decisions about where they spend their time, their money, their effort, and the like. Again, the decisions that are made in the short term are often ignoring the impact they may have in the long term. And it requires us strategically managing both of those time horizons to make the best decisions possible.
Well, Marcus, we look forward to continuing this conversation here with you in the future. Marcus Collins, thanks so much for your time.
Thanks for having me.
Coming up, we are turning to Trump's trade and tariff policies and plans with a former chief economist at the U.S. State Department. She joins us next on Catalysts. Just 1 week ahead of President-elect Donald Trump's inauguration, Chinese exports reaching a record high, putting Trump's proposed plans for 60% tariffs on Chinese imports into focus. Joining us now with more on tariffs and the impact to trade, we want to bring in Heidi Kribo-Redeker, Council on Foreign Relations Senior Fellow and former Chief Economist at the U.S. State Department. Heidi, it's great to get you on here on Yahoo Finance. Let's talk about what we should expect here from President-elect Trump. Lots of talk about the tariff policies and trade. I'm curious from your perspective, how do you see global trade evolving under the incoming Trump administration?
So I think one thing we know is that Trump is obsessed with tariffs, and so I think it's pretty. I think we'll most likely see some kind of action day one. There's a huge debate in the markets right now as to whether or not this is all bluster or whether he will actually go for some kind of a rolling out of tariffs on day one. And I think that the Chinese export data that you referred to, the fact that they actually just saw a record amount of exports of goods last year, so the trade surplus rose to almost $1 trillion. It really, I think that there will be a focus on what action he actually does decide to bring day one.
Yeah, that's certainly the focus. And one of the big questions has been whether or not there's going to be a universal tariff or something a little bit more acute, focused on things like national security. Based on your experience in government with the State Department and obviously with key economic issues, which do you think is more likely?
So there are a lot of different messages coming out of transition and out of some of the candidates for that have been nominated for important decision-making positions regarding trade and tariffs. So, I think you have some voices that are underscoring the importance of tariffs as a protection against sort of traditional trade threats, overcapacity, the types of exports and that you're seeing come out of China right now. Also, national security is a really big issue. There are very good reasons not only to use tariffs, but for sanctioning and export controls for national security purposes. And I think you have people talking about using tariffs to actually as a revenue raiser, which will bring up different points of view in Congress later when you start having the negotiations over the 2025 tax bill. What can you actually count as a revenue? What can be used for reconciliation? And and then what are the authorities that Trump himself wants to use to actually try and get his way? You've seen him make a lot of different threats about, sanction, about tariffs against Denmark in order to be able to negotiate over Greenland. And so I think there's a lot out there, and we'll just have to see what happens.
Heidi, you mentioned the fact that tariffs could potentially help with competition. They could help with security issues. That was also two things that JP Morgan CEO Jamie Dimon discussed on how tariffs could be effective going forward as a negotiating tool. I guess the question is, are you confident that Trump is going to be successful with that narrative and getting those points across, or just in terms of that execution?
So I think that it's going to be a very bumpy road, and because I tend to look at not just the economic implications for the rollout of tariffs, but also some of the larger geopolitical issues. I think in a time where you have heightened geopolitical tension, you need to have your allies and friends close. That was sort of a mainstay of the U.S. making sure that it could rely on friends when there was weaponization of any kind of economic coercion. And I think that if you take a swath of our allies and suddenly threaten tariffs, you're going to have a lot less likely friendship, friendshoring, and protection against some of the backlash we'll see in retaliation to some of those tariffs.
All right, Heidi, we got to leave it there. Thank you so much. Appreciate it.
Thanks for having me.
Coming up, healthcare deal makers are optimistic for 2025. We'll talk with the CEO of Teva Pharmaceuticals live from the JP Morgan Healthcare Conference next, right here on Catalyst. Stick around. JP Morgan's healthcare conference kicking off today. Industry leaders gathering in San Francisco discussing deal making and the year ahead for the sector. Yahoo Finance's Anjali Khemlani joining us now with more about what you need to know. And it's less about the conference itself and really about the headlines coming out of it and what it means for investors in the sector. So what do we know?
Always. It's definitely the trend setter for what to expect for the year. We know in the last year, deal making had kind of slowed down, and this year seems to be picking up just a bit. Johnson & Johnson announcing that it is going to be entering into a $14 billion value deal with Intracellular, which makes mental disorder treatments, and that dovetails nicely, according to analysts, with J&J's portfolio. Teva, on the other hand, with an announcement for a biosimilar for Eylea that's going to put it in a bit of a competitive market. There are already 4 out there that are FDA approved, including Amgen's, after it won the lawsuit against drug maker Regeneron, which is the brand maker for Eylea. But Teva is looking at the European as well, in the European market is the key focus there. So an Israeli market, of course. So that's something to keep in mind when looking at the deals that are coming out. This is looking like a little bit better for 2024 than 2023. One tiny piece of information that I thought was interesting is that this year JPM feels a little bit different. Of course, in the wake of the United Healthcare executive shooting, there are far more security on the ground, and I've heard that CEOs are even walking around with bodyguards. So that puts a little bit of a different flavor on the conference this year, but otherwise looking good on the deal making. So we'll see how things go after today.
Yeah, certainly. I've seen a lot of the headlines about security and exactly what is happening and the ramp up in security, especially when you compare it to prior years following the tragic death there not too long ago. I guess also what I would guess would be top of mind for so many of these business leaders, we're going to talk to one in just a minute, is just the industry landscape under the incoming Trump administration and how these CEOs are navigating so much uncertainty at this time.
Yeah, it seems like a lot of them do feel like wait and see. We also know some of them have made it down to Mar-a-Lago and have spoken to Trump directly. So there is some engagement with the incoming administration there. Whether or not some of Trump's appointees have any major impact on the deal-making process as well as regulatory requirements remains to be seen. I have heard that a lot of the companies have two views. Either they believe that they're going to continue to be the target of some of these price reduction and other kinds of efforts, or they could be off the hook. So even when it comes to tariffs for, say, product and biological products, that could make it out of the tariff territory. But it just, again, remains to be seen. No one's clear yet.
All right, Anj, thanks so much for breaking that down. We've got much more coming up ahead on Catalyst. You're watching Yahoo Finance. 1 week out from the inauguration of President Donald Trump, and the healthcare industry is bracing for potential tariffs under the incoming administration. Joining us now to discuss that and more, we want to bring in Richard Francis. He's Teva Pharmaceuticals CEO, joining us live from JP Morgan's healthcare conference. It's great to have you. Let's start. There's a lot to unpack, and I know we're going to be getting some headlines here from you over the next 24 hours or so, but I want to start with the Trump component. When we talk about the incoming Trump administration, how are you looking at the potential here for Trump policies and ultimately the impact that's going to have on your industry?
Well, that's a big question because we'll have to wait and see. But I think the way Teva thinks about it is whichever administration comes into the US, we've shown a track record of being able to work with them effectively. And so we would see no reason why the new administration wouldn't follow suit to that. And I think obviously there's a lot of speculation, but I'd rather not get involved in that and see actually what happens and what are the policies and what are the initiatives they want to put in place.
Are you proactively making any changes to the business ahead of any potential sanctions or tariffs?
No.
Is that something that you think is true across the board? Have you heard that from other executives at the conference, especially given some of the impacts specifically on healthcare? We know, for example, vaccines potentially could be impacted.
No, it's not been a topic where, at least in the circles I've gone in, that has been discussed. So I can't really comment on that one.
Talk to me a little bit more about how you are strategizing then, just given so much uncertainty. If you're not making any changes, we don't yet know what some of these tariff policies are going to include. We don't know the approach from HHS. I guess, where does then your priority lie, and what should we expect from Teva in the months to come?
Yeah, so I think there's a few things about Teva which I think give you a bit of background on how we think about this with the new administration. We've obviously come off a very good year because we're the largest supplier of generic medicines to the US. I think 1 in 10 scripts is filled by us, but also we're one of the fastest growing innovative companies with our portfolio also in the US. So I think we're a very big contributor to the healthcare system in the United States. We do a lot of our research and development manufacturing in the US, and the areas that we don't manufacture in the US, we manufacture in Europe. So I think when we think about what we contribute to the healthcare system in the United States and what we could contribute going forward, I think it's supportive of some of the initiatives any administration would have. Now, when it comes to us and what we're focused on is an aggressive push to innovative medicines, so that the patented products, and you saw that with some of the data that we brought out last year with our TL1A, which saw a spike in our share price. And that's the innovative side that I think whichever administration we're talking about, they like to see breakthrough medicines come through to help impact the unmet medical need, which is clearly still significant in any country. In the United States is no different from that. So I think we're focusing on that. I think that is appreciated, the amount of investment we put in our R&D in the United States and the amount of manufacturing we have in the United States. So I think as it stands now, I feel in a good place, but we'll have to see what happens with the administration and how they focus on some of the things that they've talked about in the build-up.
Richard, is M&A on the table then, just in terms of growing your footprint there?
Potentially, I mean, not necessarily M&A, but maybe in licensing. We have a pretty exciting, innovative pipeline that we were talking a lot about last year, and some of the data readouts have happened, and that's why I think the company has performed very well in the markets. And because our pipeline is so good, we have to be thoughtful and careful about the M&A or the BD we do, because we have some good assets internally, and so it's about capital allocation. And so if we did look at doing deals, it's probably more in licensing than actually an acquisition of a company in an M&A. I don't think that's the right time for us right now, but in a year or two, that possibly could change.
You also launched a generic obesity drug in 2024. In terms of your outlook for 2025, to what extent do you anticipate that specific drug leading to more growth for you, or do you anticipate it being a little bit more broadly in your broader generics business?
Yes, you're right. We launched our generic version of Victoza. And by the way, we'll be launching a generic version of Saxenda this year. So we're well and truly in the GLP-1 area. And that will drive some good growth for our generic business. But the majority of the growth of the company that you saw, I mean, we've come off 7 quarters of growth now. And that's another thing that's, I think, improved our stock price and driven our stock price. And that's driven primarily by innovative products Austedo, the treatment for tardive dyskinesia, Uzedy, treatment for schizophrenia, and Ajovia, treatment for migraine. And we see those growing at high double digit, and we continue to forecast that will happen going into 25. So those will be the key drivers for us. That said, we do have a number of complex generic launches. Victoza, the one you just mentioned, and another GLP-1 this year, but also some others that will be launching along with some biosimilars. So I think we have a nice breadth to what's going to be driving our growth in 25 and 26. But I'd always say the majority of it will be driven by our innovative patented business.
All right, Richard, got to leave it there. Thanks so much for making time for us from the conference. We appreciate it.
My pleasure. Have a good day. Bye-bye.
JP Morgan CEO Jamie Dimon was on CBS this morning over the weekend talking about some of the gloom Americans feel about the economy. He said, quote, there are a lot of legitimate concerns that Americans have, naming ineffective government and immigration as examples, but said he himself is cautiously pessimistic about the economic outlook. Joining us with more, we've got Paul Krugman. He is a Nobel laureate in economics and the author of the Substack, Krugman Wonks Out. Paul, thanks for joining us and congrats on the newly launched Substack. Talk to me about your thoughts on the economic outlook right now. How would you describe it?
Okay, right now, if you did nothing on policy, we would appear to be in pretty good shape. We got low unemployment, low inflation, we'll see whether maybe there's a tech bubble that's going to burst, maybe not, but there's no imminent threat on the horizon except for the possibility of crazy policy by the incoming administration. And so I've watched multiple transitions, and at this point, every previous administration, you had a pretty good idea of what they're going to try to do actually in their first year. Now we have campaign Donald Trump, who made all kinds of wild proposals about mass deportation, Smoot-Hawley level tariffs, and then a lot of people on Wall Street and business are betting that he won't actually go through with all of that. And I think actually nobody knows. Nobody knows what the policies are actually going to be. But if we get the Trump who campaigned, then it's a very serious shock to the economy.
Well, do you think the market's still looking at this a little bit too optimistically?
I think so. I mean, now we'll know maybe more once we're a few months in. But right now, the market seems to be getting a bit of a wake-up call in the last few weeks, but people have been pricing as if Trump 2.0 is going to be like Trump 1.0. A lot of noise, but in the end, really relatively modest tariffs on China and not much on anybody else, and no major disruption. And that's not a good bet. The people around him are different. He's different. So yeah, the market is still, for the most part, pricing a more or less normal presidency. And there's been a clear pattern. If you look at reporting, anonymous sources tell reporters, Trump really isn't as crazy as he sounds. And then Trump immediately, in an outraged mood, goes on Truth Social and basically says, yes, I am as crazy as I sound. So what to believe?
Well, if you look at the 10-year, maybe we're getting the story there. If you take a look at this chart that we got in from Torsten Slok that I know you pointed out as well, you can see the degree to which the 10-year has moved to the upside following rate cuts, which bucks the historic trend. Do you think that bond vigilantes are trying to tell us something about the incoming administration, or is the story something else?
Well, that's, again, we don't really know, but it does kind of look. I mean, I don't think that anyone is yet worried about a default on U.S. debt. That's still not in the price. But we are looking at a combination of tax cuts, so substantially expansionary fiscal policy, and tariff hikes, which will be inflationary. I think it's very hard to believe that the Fed, the expected path of steadily declining Fed funds rates is going to happen, and so yeah, I mean there is I called it the insanity premium. There is clearly a signal from the bond market, which I think tends to be a little bit more rational, if you might say, than the stock market. There's a signal from the bond market that people are seriously worried about what's coming down the pike.
Paul, does the benefit of, when you take a look at some of these policies and zeroing specifically on tariffs, and Diamond commented on it yesterday, talking about the fact that, hey, maybe they could be good or used for good when you talk about global competition, when you talk about security concerns. Do the benefits at all outweigh some of that risk, or how should investors be evaluating that?
There's a huge difference between strategic economic nationalism, which needn't be tariffs. I mean, even the Biden administration did quite a lot of subsidies to national security sensitive industries, subsidies to green energy, which had a strong nationalistic component. And that makes a fair bit of sense. But 25% tariffs across the board on Mexico and Canada, that's basically ripping the heart out of the whole North American manufacturing complex. There is no such thing as a single national industry in autos or anything else there. So yeah, you can make a case for some strategic policies, which would probably mostly involve subsidies rather than tariffs, or maybe a tariff in some cases, but that's not what we're hearing. I mean, I think it does. You should ask what's the rationale that we're hearing from the people who are going to be making these decisions, especially Trump. And Trump thinks that we are subsidizing Canada because they run a trade surplus with us. If that's, which is complete nonsense, and if that's the mindset of the people in charge, some hypothetical case in which tariffs might be a good thing is going to bear no relationship to the tariffs we're actually going to get.
Paul, I want to end on the wildfires. I know you published a piece on this morning, and obviously horrific devastation that we were seeing out in California. But I wonder about the macroeconomic impact. Is there a potential risk to something like the deficit, which you brought up earlier, that we're not necessarily thinking about accurately in the wake of those fires?
Okay, yeah, I did, great thing about Substack is I can post sort of in real time on stuff. And this is a huge shock. It's enormous devastation. Historically, however, the U.S. economy is almost inconceivably big, the whole national economy. And big economies can absorb even really large natural disasters without much visible sign. I mean, I remember looking at Japanese macro data around the time of the Kobe earthquake, which was much more lethal than anything we're seeing in LA. And the property damage relative to Japan's economy might be comparable. And you cannot see it. You can't see it even in the quarterly growth numbers. So I would say probably it's not that big a deal for national GDP. It's probably not that big a deal for inflation. I mean, it's an enormous human tragedy. And what for the state of California, obviously its biggest metropolitan area has been really severely damaged. But again, people always make the mistake with the U.S. You talk about a number, you say, well, Dr. Evil, $1 million or even $1 billion or even $100 billion. Those are all small sums compared with America.
Paul, it's always great to get some of your time. Thanks so much for hopping on with us. We look forward to continuing the conversation again soon. Paul Krugman, thanks so much.
Thanks.
Keep it right here on Yahoo Finance. We got much more of your market action ahead. You're watching Catalysts.
Cleveland-Cliffs and Nucor reportedly partnering in a bid for U.S. Steel just weeks after the government blocked a proposed takeover from Japan's Nippon Steel. That's according to CNBC. Here with more, we got Yahoo Finance's own Inez Ferre. Inez, thanks so much for joining us. What do you think this could potentially look like?
Well, Madison, analysts are saying that this doesn't really come much of a surprise that Cleveland-Cliffs would be going after U.S. Steel. Remember that they were the original bidder for U.S. Steel before Nippon even came onto the scene. So under this deal, according to this report, this would involve rival Nucor. So Cleveland-Cliffs would buy U.S. Steel in an all-cash deal and then sell Big River Steel subsidiary to Nucor. Now, Big River Steel is a 1,300-acre mill in Arkansas. It's a state-of-the-art mill. It allows for production of a wide range of steel products. The offer would be in the high 30s per share. Remember, Nippon had planned to buy U.S. Steel for about $55 per share. The deal between U.S. Steel and Nippon, as you mentioned, Madison, was blocked by the Biden administration, but the companies are suing in federal court against the decision to block that deal. So we have seen on the share price side, when we look at the stock movement, U.S. Steel up 8% on this report. You're also seeing Cleveland-Cliffs up about 5% or almost 5%, and also Nucor up more than 4%. So a little bit of a different type of deal structure, but certainly interesting coming after the block of that Nippon-U.S. Steel deal by the Biden administration.
It's a story that we'll continue to watch. And I also want to turn our attention here just to the oil industry and what the moves that we have been seeing here over the last couple of trading days. But here we are today. You've got Brent above $81 a barrel. You've got crude also moving to the upside. And with oil prices hitting 5-month highs following the latest sanctions here from the U.S. on Russian oil. I'm curious, just from your perspective, how much uncertainty does this add? Is this upping some of those maybe more bullish bets that we've been getting on crude prices?
Yeah, so the concern here is that China and India, as you mentioned, two big oil importers, they need to look for alternate supplies. And it's important to step back and note that the sanctions that were announced by the U.S. Treasury on Friday, those are an extension of a wider scope of sanctions imposed on Moscow. Now, there are these are really broad. They include traders, oil executives, insurers, 183 oil vessels, bringing the total number of sanctioned Russian ships now to 450, and half of those are carrying oil. Some of them, a large number, also are carrying chemicals. JP Morgan analysts are saying that these new sanctions include enough links to Russian oil supply chains to temporarily disrupt operations and push the cost of doing business with Russia higher. The upward movement that we've seen with oil also comes at a time, look, when the market was already in an upswing because of low stockpiles. You had colder than expected temperatures in Europe and in the U.S. That also has elevated prices and also improved sentiment when it comes to China's stimulus. So you are seeing that the oil action coming from last week and into this week, as you mentioned, you are looking right now at Brent crude up just above 81 and WTI at around $78 per barrel. Analysts aren't changing their forecast yet for this year, but certainly for the quarter, there may be some adjustments.
All right, Inez, thank you so much for giving us that great breakdown. We really appreciate it.
Thank you.
NVIDIA CEO Jensen Huang spoke about the future of robotics at CES, signaling the technology is closer than we might think.
The ChatGPT moment for general robotics is just around the corner. And in fact, all of the enabling technologies that I've been talking about is going to make it possible for us in the next several years to see very rapid breakthroughs, surprising breakthroughs in general robotics.
You just saw Juan surrounded by robots. He does see three types of those robots near term: AI agents, robots in self-driving cars, and humanoid robots as well. One company, RoboForce, wants to deploy humanoids in high-risk environments, think mines and solar farms. Joining us now, we've got Leo Ma. He is founder and CEO of RoboForce. Leo, great to speak with you. I want to get your reaction to Jensen's speech here, talking about the ChatGPT moment coming for robotics. What is that moment going to look like?
Well, that's a great announcement, and from a technical perspective, we do see and share the same sentiment and excitement. From AI robotic domain, technical angle, there are two things matter the most. One is the pure computational power. In recent more than 8 years, it goes up more than 1,000 times. And second is the availability. Startup like us have access to that level of computation power. I think that is under the hood what matters the most. That moment is the availability plus that pure computational power, turning the methods, models, and algorithm from not usable to great.
What does the timeline look like for that?
Well, we see a speed up version of the timeline. Take RoboForce as an example. We're building the most tedious, force-demanding, dangerous work that shouldn't have to be human to do, that using robo labor to do. So it would think about 5 to 10 years. We see a specific accelerating in each of the availability matter to us, speeding up. I would say in the coming 2 to 3, we'll see significant go-to-market, and then 3 to 5 years, that there will be a breakthrough time. That's in my view.
So in that 2 to 3 years, 3 to 5 year timeline, a little bit more near term, what do you anticipate the impact on the workforce and the labor market looking like?
This, in RoboForce, we believe is a significant enabler or boost in the economy that we believe. Take our focus as example, a huge solar site, utility scale solar site are delayed or canceled. And there's a wider range of application is suffering from lacking of the workers that are willing to go to that condition to work. And RoboForce and by delivering robo labor, that is creating a significant boost for that part as the labor force factor.
Leo, what are you hearing just in terms of interest from businesses, from corporations? Are there certain sectors that are showing the most interest now? And I guess just the willingness to spend more of their capital on this?
Yes, this is an exciting time for RoboForce. We just come out of stealth this mode. So we do have a list of key customers and players that express high interest to get to know and try our robo labor system as a lineup now. So we're starting focus with solar center, particularly panel installation, pick and place both and nuts, and it's being done by human, repeating millions of times. So starting there, and there's a wide range of application from ultra scale solar center all the way to space.
All right, Leo, we have to leave the conversation there. Thanks so much for taking the time to join us. We appreciate it.
Thank you.
Keep it right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow. Stay tuned for him.
It's time for Yahoo Finance's Market Minute. Stocks are mixed as investor hopes for rate cuts fade, with a key inflation report out later this week. In individual moves, shares of Moderna plunging after the company lowered its 2025 sales guidance by roughly $1 billion. The revised forecast comes as the drug maker expands its cost-cutting program, expected to reach $1 billion this year. And tracking retail giants, Lulu hiking its fourth quarter guidance on strong holiday sales, shares are flat. Abercrombie did the same, but saw the stock plunge nearly 20% as year-over-year growth is expected to stall. And Macy's disappointing after the company expects sales to be at or slightly below previous guidance. Plus, Bitcoin taking a breather, trading just above 92,000 a coin. Prices down about 10% over the past month, despite spot Bitcoin ETFs pulling in over $100 billion in total assets in their first year of trading. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Wealth starts now.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, portfolio housekeeping. Fidelity will help run us through a 5-point checklist for evaluating your portfolio in 2025. And does it really cost $1 million to retire in some states? We discuss myth versus reality and reveal some of the top recommendations broken down by generation to build your retirement nest egg. Plus, your 2025 job hunt. We discuss best practices when applying and reveal the best time of year to hunt for a new gig. All that and much more coming up during today's show. But first, we take a look at some market action. We're 90 minutes into the trading day. Stocks, they are mixed to start the week. Dow Jones Industrial Average, it's up fractionally right now, 90 minutes into trade by about 0.4%. S&P 500 and the Nasdaq, though, still got a little slippage taking place there. Joining me now, we've got Thomas Martin, who is the Global Alt Investment Senior Portfolio Manager. And Thomas, you say that the range of expectations for 2025 are narrow, but the potential outcomes are wide. Just walk us through what that means for the S&P 500 and the Fed.
Sure, great, and thanks for having me on your show. Yeah, it's all the strategists at the right around November put out their expectations for a target price for the S&P 500, and a lot of times the standard deviation of those estimates is fairly wide, and as is the percentage gain that they're expecting. But that's come in this year. It's one of the lowest standard deviations in a while, and the rate of return that's centering around, at least from November, was about 10%, which is in line with the long-term, decades-long-term market average for the S&P 500. So that, to me, says that the strategists are fairly conservative in the kind of bets that they're willing to make in terms of outliers. But if you look at what the factors are driving the markets, potentially driving the markets, well, with all the policy uncertainty, the rates being where they are, inflation expectations being difficult, you could easily see a down market even at the end of the year, or a very strong up market. So there's a wide range of expectations, and we're sort of getting a preview of that at the beginning of this year, where you're getting close to a pretty good correction.
And so all that considered, and I expected you to say where earnings would drive this. What is the earnings narrative going to be from your estimation? Big banks are going to be kicking off earnings season this week. So your anticipations here for earnings this year?
So for the whole year, for 2025, it's right in the 15% range year over year for the S&P 500. And that really is more back half dependent, as you're going to see low teens in the first half of the year, maybe a little bit less so even than what we're expecting for the fourth quarter of this year, and then kind of a ramp up. And I think that's where the the uncertainty lies, is that those numbers are far enough out that it's hard to predict what those are going to be. But let's just say that we got 15% earnings growth this year, and the expectation is for 10% rate of return. That means that you have to have multiple contraction as a result of that. And that could be driven by interest rates being a little bit higher, which they've already started to do, and also that just valuations were high and sentiment was high to begin with, and that needs to normalize.
And so all these things considered, what sectors do you see with the high growth potential this year?
Well, we're going to get a taste of it when we report fourth quarter earnings, with the banks in particular, and financial stocks are expected to have the highest rate of growth for this quarter. Now that is expected to moderate going forward. You're still going to get decent earnings growth from the sectors that have carried us the last couple of years, which is information technology and communication services. But it's broadening out, and you're seeing materials and healthcare and the financials all having decent growth, and the majority of industries having over 10% growth, which is pretty attractive for equities.
So walk us through some of your stock picks, the individual names that you think are set or well positioned to outperform this year.
Sure. The names that I like to talk about with folks this year are ones that what you call self-help type companies, and those are companies that because of their situation or their industry situation, or more particularly their positioning within the industry, gives them the opportunity to either raise prices or increase revenues and increase their margins. And so one of those examples is a company called Freshpet, which is pet food, but it's fresh pet food, as the name says. And the thing about this company is that they have a very low market share of overall pet food, somewhere around 4% of what is about a $37 billion industry, bigger than quantum computing, just as sort of a funny touch point. But in addition to that, they have very high market share, if not being the 90% leader in fresh. They have a lot of expertise in that they've built up over time, and they have a moat, and they have a way to get further penetration into their customers' wallets, get more customers, and then increase penetration through their distribution center. So that's an example of a company that has a lot of ways that they can increase their earnings.
Yeah, I did not have Freshpet and quantum computing even being in the same stanza on my bingo card. So thank you for checking that one off if somebody's out there. What is your top tip for portfolio evaluation this year?
So this year, because you're coming on the heels of two very strong years in the market, which you could say were more ebullient, not to say speculative, but you have to get down to fundamentals this year, and that's why I pick companies with strong and improving fundamentals. And diversification is very important. And from a total portfolio management perspective, you need to be prepared to not have to sell something when the market's down, either because you need the money or because you feel uncomfortable with that. So you have to have the right amount of cash in your portfolio to cover those kinds of needs and to let you sleep at night. Now, that used to be an inclusion in bonds, and perhaps that's a bit better on the shorter end than on the longer end, since we don't know where the longer end necessarily is going to end up. But with regard to stocks, you still want to be diversified, not load up all into one sector or industry or theme or hype. So having diversification across those sectors and across the asset classes is really important to increasing staying power so that you can hold on to your wealth for the years to come.
Thomas, thanks so much for taking the time here with us today. Really appreciate it.
Great. Tthanks for having me.
Certainly. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, the CEO of Sonos, Patrick Spence, is stepping down following major issues with the firm's new mobile app that resulted in many customers being unable to connect to or use the speakers. Sonos did report a double-digit revenue sales decline in the fourth quarter. Tom Conrad, an independent member of the board since 2017, has been named interim CEO. The board is searching for an official replacement. Next up, we're tracking shares of A&F, Abercrombie & Fitch, raising its fourth quarter sales outlook to 7 to 8% growth, surpassing the prior range of 5 to 7%. And the retailer also increasing its full year net sales outlook to around 15%, the higher end of its previous 14 to 15% range. But it wasn't enough for some investors here. As you can see, shares falling steeply by about 19% today. And finally, real estate development firm Howard Hughes is rising after Bill Ackman's Pershing Square proposed a merger. The deal would merge a newly formed subsidiary with Howard Hughes. Ackman used to be chairman of Howard Hughes, and the deal is for $85 per share, the majority in cash. 2025 could be the year for small caps. Yahoo Finance's Josh Lipton joins me now with more on a look at what investors need to know about the small cap trade this year. All right, what do we need to know?
All right, Brad. So are small caps indeed the place to be in 2025? Are investors wise to commit capital to pint-sized companies in the year ahead? It is a subject of great debate on Wall Street and here on Yahoo Finance. Now, the iShares Russell 2000 is that ETF that tracks the small caps. Over the past 12 months, it's up about 12%, though that does trail the broader market as gauged by the Spider S&P 500 ETF, which is up roughly 21% over that same time period. Now, fans of small caps bet that a strong U.S. economy and lower interest rates, or at least rate stabilization, will be tailwinds for this group in the year ahead. They also point to what they see as relatively attractive valuations and highlight expected strong earnings growth.
What we see happening this year is an environment where earnings growth is broadening, not just small cap versus large cap, but even within large cap. It's no longer going to be a world that's just the Mag 7 driving earnings growth, but it's going to be across many other sectors and also down market cap. We expect earnings growth in the Russell 2000 this year could be above 15%, which will be at least competitive, and we think actually above what the S&P will show.
But before jumping into the small caps, it's important, of course, to hear the other side of this trade as well. There are well-known strategists who are more cautious on small caps. For example, Jill Carey Hall at B of A telling clients that the small caps have the most post-election policy risk, continued EPS challenges, and refinancing risk is back, she says. And how about the technicians? What are the charts telling them about small caps now and ahead? Well, Jeff Bierman, chief market technician for TheoTrade, tells me that the Russell 2000 doesn't have as much downside potential as the Nasdaq 100 or S&P 500, though Bierman argues investors should not take an across-the-board bullish take on small caps. They must be selective, he says, savvy stock pickers rather than indexers. His favorite small cap picks for 2025 are Box, Radnet, Zurn Elkay Water Solutions, and Bellring Brands. Bierman saying all four stocks are in technical long-term uptrends while in the midst of making healthy corrections to their overbought conditions, Brad.
All right, excellent breakdown there. We're going to be watching this trade very closely, playing out the rest of the year. Appreciate it, Josh.
You got it.
Saving more money for retirement and investing more money are two of Americans' top financial goals for 2025, according to a recent bank rate survey. So, we want to review some portfolio housekeeping tasks from Fidelity that everyone can do as we kick off 2025. Here is the checklist. Review your 2024 portfolio maintenance, make a financial plan, evaluate your asset mix, and consider sector and stock-specific exposure. Here to discuss, we've got Heather Knight, who is the Fidelity Investments Vice President and National Brokerage Coach. Heather, great to have you here with us. Let's jump into the first thing on the checklist. How do you use your 2024 portfolio performance to enhance those 2025 decisions?
Yeah, thanks for having me today. And first thing I would say really is the one thing that you want to do is to compare your end of year portfolio performance to a benchmark or an index that might be relative to your portfolio. So that's going to give you that starting point, and then check for underperformers. Look at the underperformers in that portfolio. Ask yourself, has something changed with these positions since you bought them? Would I be willing to buy those positions today? And then, of course, I usually like to tell folks at the end of the year is a great time to compare those positions. For example, you might find a lower cost ETF or a better performing stock or an undervalued in the same industry or sector. So I would check my positions on Fidelity.com each quarter, particularly for myself, but at least try to do that at least once a year. And remember this too, that ETFs, there's a new one that comes out every day. There's a lot of mutual funds out there. So make sure those objectives align with your goals and expectations.
Yeah, that's a great point. Number 2 on your checklist as well here. Talk about the importance of a financial roadmap.
Yeah, so having a financial roadmap is really important. And over the last few years, I've worked with a lot more clients that tend to be DIYers, those folks that tend to prefer to manage their investments on their own. And that's due to the better technology, financial literacy, and of course, some other competitive market dynamics. So whether you make your own investment decisions or work with an advisor, I'd say start with the end in mind. Your goal is going to help you draw out that financial roadmap and determine what you're going to be investing for. And that's going to help you give that timeline to something that you're working towards, essentially.
Number 3, and this is all about looking at your asset mix, really what's making up the total pie here. So what percent of your portfolio is stocks, is bonds, is cash? And we know this tends to vary based upon what generation you're in.
Yeah. Absolutely. I mean, you have to look at diversification in a couple different areas. And I think it comes down to that time horizon. So thinking back to your goal, making sure that you have a proper asset mix is really important for diversification. So are you investing in stocks, bonds, cash, alternatives? How diversified is that bond portfolio and stock portfolio? And making sure that you're not concentrated in some of those areas. So that asset allocation should really reflect you and your goals. For example, if you're a long-term investor and you have that higher risk tolerance, you might have more exposure to stocks than maybe some other assets. Fidelity.com has some sample portfolios that you can reference as well. Other considerations when looking at diversification should include your time horizon, risk tolerance, and your financial needs, of course. And finally, I would say this, even when you're thinking about doing things on your own, like myself, I tend to be a little bit more DIY. I think it's really important to get a second set of eyes. So you might find that you might be overlooking a critical piece of your portfolio, and then you can partner with an advisor. We no longer live in a world where it's all or nothing, meaning just because you work with an advisor, it doesn't mean that you're committing to a full management of your portfolio. And then, of course, rebalance is needed.
Number 4 here on the list, and I got to hustle to my finish here, but specific sector exposure, how do you evaluate that?
Yeah, for me, I actually take a look at, I tend to take on more of a core satellite approach. But overall, when you're looking at different sectors, I think it's really important to focus on the research that's behind it. Think about what's currently happening right now, the business cycle analysis, economic trends, and determine what sectors or themes might make sense to be a part of that portfolio overall. That's what I typically will do for my satellite positions.
And just lastly, while we have you here, stock picking, how do you analyze specific holdings?
Yeah, absolutely. You have to do some research. Determine if those investments are what the thesis is for holding those and if it's still strong. I tell folks before buying a stock, you should answer these questions. Why am I buying the stock? How much am I willing to gain? How much am I willing to lose? And what's my time frame? That helps us to establish a baseline and can help us remove some of that emotion that we tend to get with stocks. The bottom line is have a strategy in place before you buy the stock.
Heather, we got 15 seconds here. Give us your top tip for people evaluating their portfolio.
I would say overall, focus on your time horizon, your goals, make sure that you feel comfortable with them, and absolutely reach out and get some help if you need to. There's plenty of people out there that will be a partner in crime when it comes down to your portfolio.
Heather Knight, thanks so much for taking the time.
Thanks for having me. Take care.
You too. Coming up, is now the time to buy into bonds? We'll discuss with a portfolio manager next. U.S. Treasury yields have been on a tear as of late. The 10-year yield alone has soared more than a percentage point in 4 months and is nearing 5%. Investors may be asking, is it a good time to be invested in bonds? Here right now to discuss, we've got Tom Tezoris, who is the head of fixed income research and chief fixed income portfolio manager at Strategic Securities. Tom, great to have you here with us. First, let's just start there. Is now a good time to consider investing in bonds?
I'd say generally yes. I mean, obviously there's still further upside risk in yields. The economy is still strong. We are very likely looking at a second wave of inflation coming sometime in the next 12 to 24 months. And we have to deal with very large deficits, previous deficits that need to be refinanced into longer duration bonds, as well as potential future deficits. With that said, we're very late in the business cycle right here, and that means there's a great deal of risk to credit and equity markets and the economy as a whole, and you really can't get that type of protection from an economic downturn from anything other than safe haven assets like long duration U.S. Treasuries. So for buy and hold investors, right now is, generally speaking, a very good time to be entering into bond positions. Likewise, if you're a buy and hold investor, you're probably going to exceed inflation by a good 100, 150 basis points. So there's an attractive entry point, but it could get more attractive.
Okay, and so if someone holds bonds right now, should they sell or keep holding them?
Generally, we advise against selling. And so we're telling clients it's not a time to be a hero and it's not a time to panic. That is, we'll probably see a better entry point, but at the same time, we're very likely to see yields eventually reverse lower. So if you're looking to liquidate because you need cash, there will probably be a better time to do that in the not too distant future.
So which duration right now are presenting perhaps the most attractive opportunities for investors?
For the most part, between the 5 and 10-year portion of the curve. And there's a few reasons for that. One is because, again, you are being compensated versus where inflation is today and where inflation is likely to be. So you have yield pickup on top of inflation in the 5 to 10-year portion of the curve. You also don't have a very large amount of duration, that is interest rate risk, when you're starting to look towards like a 5-year portion of the curve. And what's more, even if you do have to liquidate that position, you're anticipating you might need the cash in a year. A year from now, the yield curve is so upward sloping that for the most part, you're actually pricing in price gains on top of the yield you're picking up. And that's simply a phenomenon of the upward sloping or lower duration yields being below longer duration yields. 10-year portion of the curve, you pick up a little bit more yield, but you obviously pick up more risk. So somewhere between that 5 and 10 year seems to be the sweet spot.
Okay, so broadening out here, any advice to young investors, perhaps early 20s, who are evaluating the bond marketplace right now?
Yeah, and I'd broaden this out to young investors in general, and that is the era of very low financial volatility, stability. That was an illusion. That's not normal. In the case of yields, yields are not only supposed to be higher than what they were last decade, but much more volatile. Yields typically are very volatile, and that translates into volatility in other corners of the globe, not just bonds, equities, Bitcoin, gold, everything you can think of. So there was an illusion of the last decade of price stability, of asset stability. This is more normalized, what we're seeing today. So that doesn't mean we're going to see this level of volatility every day for the next 10 years, but this is more the norm. So the advice to younger investors is recognize that volatility is probably here to stay in some form. And unfortunately, the thing about volatility is it comes at points when you least expect it.
Isn't that the thing, though, when you're a younger investor, your propensity for risk should be a little bit higher because of the long-term nature of how you're investing as well? So within that question, I guess there's a question within a question of how much should you be allocating towards bonds, even if you are already seeking more risk?
Well, typically, if you're a younger investor, let's say less than 30, you might not want to be allocating a whole heck of a lot to bonds right now at this point in your life. But because we are so late in the business cycle, and by that we mean this has been an expansion that has lasted, we'll call it 4 years. There's been tremendous growth for much of that 4-year period, and equity prices have seen exceptional appreciation. Right. You probably have more than typical price risk in equities. So a slightly larger allocation to bonds for younger people might be more warranted right now. With that said, you're probably still talking something less than 20% of your portfolio.
Interesting. Tom, thanks so much for breaking this down for us.
Yep. My pleasure. Thank you.
Certainly. The first spot Bitcoin ETFs starting trading 1 year ago on Saturday. Altogether, they've drawn in $36.3 billion in net inflows, according to Strategas Securities. Here to chart that performance and take us through some of the biggest winners and losers, we have Yahoo Finance Markets and Data Editor Jared Blickery. Hey, Jared.
Thank you, Brad. 1 year ago today, the SEC lit a fuse on one of crypto's most important milestones, one that many crypto investors called a holy grail moment: approval of a spot Bitcoin ETF in the U.S. The chair of the U.S. Securities and Exchange Commission, Gary Gensler, who approved the approvals based on years of concerns over fraud and manipulation, he is stepping down next week, making way for a new chair to serve under incoming President Trump. Now, investors have poured over $100 billion into 10 new exchange-traded funds, and key winners have emerged in this winner-takes-most environment. But first, it helps to look back and think about how we got here and why something as simple as approving a new class of ETFs was so contentious. In 2015, Grayscale Investments, they launched their Bitcoin Trust as an exchange-traded note, or ETN, which is like an ETF, but it could only be legally bought and sold by so-called sophisticated investors. In 2021, the SEC approved ProShares Bitcoin Strategy ETF, but it was based on Bitcoin futures. And Bitcoin futures-based ETFs, they have issues tracking the actual price of spot Bitcoin. In Gensler's SEC, it refused to approve these ETFs based on it. So in a key decision, Grayscale Investments sued the SEC so that it could convert into a spot Bitcoin ETF. And this would be GBTC, by the way. As the case progressed, the price of Bitcoin surged on any favorable news to Grayscale, which finally won the case on August 29th, 2023. The SEC predictably appealed, but lost its battle against Grayscale in mid-October. Bitcoin soared as the SEC neared approval of a suite of new ETFs in November and December. And by the time launch date rolled around on January 13th in 2024, the price of Bitcoin had more than tripled from 50,000, that's 15,000, to 45,000. After that, there was a brief sell the news decline, but 2 months later in March, Bitcoin touched $70,000 for the first time. And over that time, investors scooped up these new ETFs, and clear winners emerged. The iShares Bitcoin Trust, ticker IBIT, would prove one of the most successful ETF launches in history, measured by investor uptake. Over the last year, investors poured over $37 billion into it, bringing its assets to over $50 billion. Now, Fidelity is a distant but respectable second place, taking in $12 billion, and thanks to Bitcoin's price appreciation, its value is just shy of $20 billion. Grayscale's GBTC is an interesting case. It successfully converted to an ETF based on spot Bitcoin on the big launch date, but investors have mostly been selling it because of its 1.5% management fee, which compares to an average fee of about 0.25%, that's 1/6 Grayscale's amount, for most of the others. WisdomTree's Bitcoin fund under the ticker BTCW has seen the lowest investor flows, around only $230 million, and also joining the group VanEck, CoinShares, Galaxy, and Franklin. They also investors poured in under $1 billion into each of these. Later in July last year, Ethereum, we haven't mentioned that yet, but Ethereum would have a similar run as a spot Ethereum ETF. That was approved as well, a whole suite. And now, with a full complement of Bitcoin and Ethereum ETFs, investors can finally buy into the crypto market with ease in their 401ks, and the stage is set for the next leg of crypto's journey, as former SEC Commissioner Paul Atkins is set to take up the SEC's leadership under Trump. Back to you.
Jared, great breakdown there. Thanks so much, and a great look back as well. Coming up, do you really need $1 million to retire? We're breaking down how much you should have saved at every age. That's coming up. A new survey from Go Banking Rates calculates that you need $1 million or more saved to retire in 15 U.S. states. But our next guest says it's not all about the numbers here. Anthony Siccaro, Providence Financial and Insurance Services President, joins me now here. Good friend of the show. Anthony, what are people missing here?
Yeah, there's a number of myths out there as far as how much do you need to retire. You need $1 million, some people say. Some people say you need 80% of what your pre-retirement income is. None of that's really true. What you need is you need income. Retirement is all about as much income as you can get for the rest of your life. That would be a definition of successful retirement. If you need $60,000 a year out of your portfolio, that's a 6% withdrawal rate on $1 million. That's not enough. On the other hand, if you've got a very large pension coming in and Social Security and you're saving a lot of money because you don't need it all, then you don't need anywhere near $1 million. So it's all about the income. It's not about the total asset size.
So you have different advice for people at different life stages here. What should you be doing if you're young?
Yeah, if you're in your 20s, 30s or so, you want to be invested aggressively, almost aggressively as you can. You want a dollar cost average. Dollar cost averaging is the process of having money taken out of your check, going into your 401k over and over and over again. The math behind it drives the average purchase price down, and that's what you want to do is you want to buy low. If you're in your maybe your 40s, 50s, then you want to start, especially 50s, you really want to start shifting more towards more conservative investments. So it's not 80 or 90% aggressive like your 20s, 30s. Maybe you get into more of that 60-40 strategy when you're in your 50s and start focusing on investments that pay some interest and dividends and some growth. When you get into retirement, then it becomes more about the income. The challenge with retirement is if you're invested right before retirement like you were in your 20s and 30s, and we have a huge market crash and you never reallocated your portfolio and your portfolio crashes with it, now all of a sudden it could delay your retirement. So you can't put yourself in that position. Now is the time, or when you're in your 50s really, is the time to start showing up, being more conservative and focusing more on income producing investments.
With the cost of living rising every year, how should Gen Z and beyond be planning?
Well, we get that question all the time from younger people, and the question becomes like this: well, how much should I save? My answer is this: as much as you can. The reality is we don't know what's going to happen when you get into your 60s and 70s, but we do know that inflation is going to continue growing, and it's not uncommon for goods and services to double every 13 or 14 years at a 3% rate. That's about the way that it works. So you want to save as much as you can. If you do need $1 million today and you're in your 30 years old, you're probably going to need $2 to $3 million when you get out to 60 years old. But again, it's not about the asset size. It's about the income, and you want to do everything you can to grow your income.
So what are some of the benefits and drawbacks to both high and low cost of living areas?
So the high cost of living areas obviously are going to be where a lot of people have grown up. A lot of people were indoctrinated. I'm a native of Los Angeles. It's a very high area. And they basically say once you leave, you cannot come back because it's so expensive to live here. But I've got my church, I've got my home, I've got my friends, and I'm indoctrinated here. I'd like to leave, but I really can't. On the other hand, if someone is retired and their kids are out of the house and they're not tied, moving to a lower cost area absolutely makes sense. But I want you to be in a position to be able to stay where you are if you want to and not be forced to move. And if you've done some good retirement planning ahead of time, you started saving early, or maybe even you started saving a lot later in life, you should be in a position to where moving to a lower cost state is an option, not a necessity. And unfortunately, a lot of people haven't saved enough and then they're forced to move to a lower cost state.
And finally, while we have you, what is your top portfolio management tip?
So for people that are retired, which is what my firm focuses on, people that are retired, I want you withdrawing from interest and dividends out of your portfolio. I don't want you following the rule of 4%, which essentially says that if you're invested in growth investments, you can sell 4% of your assets every year and you should be okay. The challenge is if you're selling assets every year to get your income, then at some point in time, if you live long enough, you could run out of assets. On the other hand, what we teach our clients to do is how to focus on interest and dividends. If you're living off of interest and dividends, then you don't ever have to worry about running out of principal. If you're not selling the farm and you're living off of the produce, then you'll always have that income from the produce coming in. But if you're selling the farm to fund your retirement, eventually when that farm's gone, so is your retirement. So live off the interest and dividends.
Anthony, thanks so much for taking the time here with us. Great to see you.
Thank you, Brad.
Certainly. Coming up, looking for a new job, we have an expert with all of the tips to help you stand out. Stay tuned. The U.S. offers numerous visa categories for temporary foreign workers that cover a range of workers, agriculture to entertainers to tech workers. Here to break down some of the international workers' ways to get permission to work in the U.S. is Yahoo Finance's Jenna Herron. Jenna, what do we know?
Hi, thanks, Brad. So there are so many ways for foreigners to come to the United States and work in a non-immigrant status. And the State Department lists 11 visa categories for this, and they make up about 0.5% of the US workforce. And the names of these visas are kind of like an alphabet soup. So celebrities, athletes, people with extraordinary ability in business or education can come to the country on an O1A, O1B, a P1A, P1B, P2, or P3 visas.
Okay.
There are also visas for workers in cultural exchange programs. Those are Q1. Business transfers, those are L1s, and workers in certain training programs, such as educating kids with special abilities, H3. But the biggest ones, and I think the ones that you're probably most familiar with, are the H1B workers, who are those highly skilled workers, predominantly in STEM industries, but also in education, manufacturing, and healthcare. And then there's the H2A workers, which are seasonal agricultural workers, and H2B workers, which are also seasonal, but they're non-agricultural. So they're like in landscaping or construction. So you put those three visa programs together, and they represent about 84% of the total temp worker visas that go out. And they're also the ones that have kind of raised concerns about displacing American workers or suppressing wages for U.S. workers in similar positions. And the government tries to address these concerns. Employers have to first apply before they can get these visas, and they're not always approved. They also have to attest that they tried to find U.S. workers first to fill those positions. And then they have to pay the visa workers either the prevailing wage of the region for that position or whatever they're paying U.S. workers, whichever is higher. So that helps. The results are a little bit mixed, though. There are some studies that show that some visa workers are getting paid less, but there are other studies that show like H-1B workers are getting paid a little bit more than U.S. workers. What's really clear, though, is that there are many industries that have worker shortages, and that was made really much worse during the pandemic. And these temporary workers who come over are filling in those needs. But at the same time, we need to balance that out with what our U.S. workforce can do, and if we need to retrain certain workers so that they can participate in our economy.
What's the usual duration? I know we got to go, but what's the usual duration that these visas are approved for?
So it really depends on the visa. They do range. For the H-1B, for example, it's initially 3 years, can be extended to 6 years. For the seasonal workers, it is for however long they need for the particular work that they're doing. But they can be extended, and if they go to a certain amount of time, then they have to stay out of the country for 3 months before they can reapply for another seasonal visa.
Wow, great breakdown. Thanks so much, Jenna.
Yeah, thanks.
Appreciate it. While recent data shows the job market remains healthy, with the economy adding 256,000 jobs in the month of December, here are some trends that can still make things tricky for job seekers on a day-to-day basis. For example, ghost jobs, or roles that companies post online but don't have any intention of filling. They make up 22% of jobs advertised online, according to the hiring platform Greenhouse. Examples of ghost jobs include positions posted that are filled internally or postings used to give the perception that a company is growing. Joining me here at the desk, we've got Eliana Goldstein. She is the founder of Eliana Goldstein Coaching, and we've got to start off with the best way to land a job in this environment here. What are some of the strategies you're putting to work in advising?
So what's most important to recognize is that the emphasis on let my resume just be perfect and do all the work for me is just not accurate, and it's not going to work. Because the job market is so competitive and there are so many highly qualified people, you have to really focus on other ways to stand out. And I think job seekers are coming to realize that it doesn't matter how good my resume is, what I need is a connection or a referral, which is why we're seeing these referral platforms pop up where people at companies are trying to make referrals a side hustle and basically give referrals to anybody to make some money off of it. And employees or potential job seekers are looking to that to try to get into companies. So while yes, it's important to have a strong resume, what you need to focus on is building relationships and getting connections directly to jobs to really make an impact in 2025.
Let's linger there for a second here. What tips do you have for job seekers that are looking to build those authentic relationships professionally?
So first, you really need to be clear on what it is that you want to do, and that's something that people really struggle with, because in order to properly market yourself and be able to build an authentic relationship with somebody in a role or industry you want to be in, there has to be a clear connection there, right? So if you're like, I'll do this, but I'll do that, and whatever I can do to get a job, that's not going to be meaningful. So say, this is a specific type of industry I want, the specific type of role, and these are the target companies. Now let me find people within those companies who are closest to those roles that I want for myself, so I can reach out to them and share, hey, here's how I can provide value to you and why I would be a great person to be able to join this company.
You know, let's be real here. I mean, you have to go through some form of artificial intelligence more often than not now in order to break through and get a call or get an email. So how can we also on our end use AI as a tool to break through the black hole of online applications?
So I think it's really important to use AI to better, if there is a job posting and you're trying to now build a connection with with somebody at that company in relation to that job. Use AI to figure out, okay, what are the clear skills needed in this job description? We're really moving to skills-based hiring versus traditional credentials. So being able to say, okay, these are the 5 skills that are clearly the most important. Let me make sure to really emphasize that within my resume, within my LinkedIn, right? Things like that. And using it to be more efficient. If you are going to write a cover letter, which again, probably isn't as important as it was in the past, using it to be able to really be more efficient in writing that cover letter as opposed to spending hours crafting all these different cover letters. So for efficiency, for really breaking down job descriptions, understanding skills, it's going to be really helpful from that perspective.
Maybe I'll turn my cover letter into a cover portrait or something
Yes,
like that. And just
differentiate yourself.
Yeah, it's a picture book at this point.
Yeah.
If we aren't customizing our resume to a specific job, what tips do you have for that basic, strong resume that you can hand in once you make that connection at the job of your choice?
So what I always like to say is you need a value-based resume versus a task-oriented resume. So a task-oriented resume basically regurgitates a job description where it's basically just saying all the things that you're reading and trying to and making it, okay, I can do this, I can check that box, right? But who does an employer want to hire? They want to hire somebody who they can clearly see how this person is going to come in and shape the team and add value to the team. So don't just say what you did in the role, but say how doing that drove tangible value for the team, for the organization. So think about the impact behind every single statement that's on your resume.
What results did you bring to the table?
Yes, exactly.
What is the best time of year to find a new job?
So traditionally, Q1 is always very strong. Yes, and that's because it's the new year. Budgets are reallocated. People are back from vacation, so they're ready to hire and onboard. I think that there's a little bit more uncertainty in the job market right now, a new administration coming in, so we're not exactly sure how things will pan out. But as you talked about earlier, December was very strong from a jobs being added perspective. So hopefully that trend will continue going into Q1.
Eliana, great to see you. Thanks so much for joining us here in studio. Some very actionable tips for those job seekers out there. Well, there are plenty of jobs out there in 2025, but finding the role is only half the battle. Once you get the interview, how do you stick the landing? Yahoo Finance senior columnist Carrie Hannon reached out to a handful of experts for their insight, and she joins us with those now. Hey, Carrie.
Hey, Brad, great to be here. So you get in the door, you've got this interview, so it's showtime, right? Now, this is really a wonderful time to showcase who you are and what you can do. And the first thing that people need to do when you're in that situation is what I call them your car story, which is your challenge, your action, and your result. So what you want to do is you're talking to your prospective, your hiring manager or what have you, and you want to say, okay, what was this challenge you faced? And so what did you go ahead and do to make a change here? And what was the result? So what they don't want you to say, it has to be very quantifiable. They don't want you to say, oh, I'm self-motivated and I was able to, really achieve X, Y, and Z. But that X, Y, and Z needs a number. So you need to say things like, I was able to increase sales by 125%, and I brought in an extra, $800,000 in sales in the first quarter because of my great network, my relationship building. So you really say, hey, what you've done. So it's very easy for someone to grab a hold of. Hiring managers absolutely love the numbers. They want to see what you've done. The second thing is really, share stories. This is a conversation. Don't get so uptight. You're having a conversation with somebody and you're going to be a little bit honest. Where did you fail? What kind of mistakes did you make at some point? And what did you do to solve that problem? They want to know that you're kind of self-aware of who you are. And it gives a sense of humanity, of who you are as an individual. So it's not just all the song and dance. You're actually saying, let's be realistic. I have faced challenges, and this is, I made a mistake, and this is how I corrected it. The third thing, Brad, I absolutely love this one, is wear your love for that company, for that employer on your sleeve. So when you go in there, you need to really demonstrate and be able to articulate, why do you love that company? Why do you want to work there? Is there a product that just really turns you on that you just think is the most magnificent thing? And you need to say that. You have to say why you love this product, or maybe it's the mission of the company that you go, I've always wanted to work here because it just so aligns with who I am. But, so these are the things that you need to think about ahead of time. So when you get into that chair, you're very comfortable answering and relaying this kind of information. And one example that was given to me by by someone I interviewed was what Google does. Like Google will say, okay, what's your favorite Google product? Great, terrific. So why is it your favorite product? And okay, how would you improve that product? Now that's tricky, right? So there you go. I mean, you need to be really thinking ahead, but embrace why you want to work there.
Carrie, thanks so much. Really great insights and some tools that can hopefully be put to use for a lot of viewers out there. Appreciate it.
Thanks, Brad.
We've got much more on wealth after the break. You're watching Yahoo Finance. A programming note. In this week's episode of Financial Freestyle with Ross Mack, the CEO and co-founder of Keychain emphasizes the importance of introducing and streamlining products to the market, highlighting the positive impact that they can have on consumers.
And what we want to do is we want to take that spark of innovation, and we want to make it so easy to bring product to market so that innovation happens faster. And our belief is if we do that, if we make it easier for, the big grocery brands to launch products, if we make it easier for, every person who thinks about like, hey, I really want to make a healthier product or a better product, if we make it easier for the bigger guys to launch products, that the product quality on our shelves will go up and the health of our society will actually increase because we'll have healthier food, healthier drinks, healthier beverages, healthier, beauty products.
New episodes of Financial Freestyle air Mondays at 12 p.m. Eastern Time. You can catch them on Yahoo Finance or wherever you get your podcasts. Let's get a check of the markets here. We're taking a look at the major averages in the U.S. And as of right now, we are mixed. The Dow is up by about 0.1%. The S&P 500 and the Nasdaq, both lower here right now. For the Nasdaq, the tech-heavy average, you're seeing that down by about 1.4%. The S&P 500 down by about 0.7%. Much of those declines, as we were talking about, the tech-heavy Nasdaq technology sector certainly weighing on the markets here today. There you're taking a look at XLK, the S&P 500 technology look at an ETF form, and you're taking a look at XLK down by about 1.5%, and then additionally XLU, you're seeing that down by about 2% right now. Utilities, semiconductors also slipping with tech today. We're keeping close tabs on SOX, the Philadelphia semiconductors. There, you're seeing that down by about 1.25%, 1.3%. Meanwhile, energy and materials, they are one of the bright spots that we're tracking in today's market activity. Both of those higher. The energy sector up by about 2%. We're also watching Bitcoin fall right now. It's trading just below 92,000. That's off of the 24-hour lows that we saw it hit of about 90,000 here. So continuing to keep close tabs on that. That's down right now by about 3.5% here over that 24-hour period. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time.